Good morning and welcome to the Public Service Commission as we resume the hearing in docket numbers 2023-388E concerning Duke Energy Carolina's request for a rate increase and 2023-403-E regarding Duke Energy Carolina's grid improvement plan. Let's take a roll call of commissioners. With us virtually, we have Commissioner Caston, present in the hearing room. We have Vice Chair Powers, Commissioner Thomas, Commissioner Carolee Williams, and Chair Belser. Looks like we have counsel for all parties, and just want to check. We have CCL votes Solar Council remotely. Is that correct? Virtually? Getting nods in the back. Good morning, Ms. Clancy.
Yes,
Mr.
that's
Gooding.
correct. Thank you. Good morning.
Thank you. We are still with Duke Energy Carolinas. Mr. Robinson.
Yes, thank you, and good morning to you, Chair, Vice Chair Powers, and the Commission. At this time, the company calls Jim Coyne and Chris Bauer. Thank you.
Thank you.
Do you swear affirm the testimony you're about to give to be the truth, the whole truth, and nothing but the truth?
Mr. Meadow, looks like you're up this morning.
Thank you, Chair Belser. Yes, I have the pleasure this morning. And good morning to you as well, and to all of the commissioners, and to you, Mr. Coyne and Mr. Bauer. Mr. Bauer, why don't we start with you? Are you the same Chris Bauer that appeared before this commission about a week ago? I think it may have been exactly a week ago.
I am.
And could you just state your name for the record, please?
Sure. My name is Chris Bauer.
And by whom are you employed and in what capacity?
I'm employed by Duke Energy Business Services, and I'm the Director of Corporate Finance and the Assistant Treasurer.
Mr. Bauer, did you prepare or cause to be prepared under your supervision rebuttal testimony of 39 pages that was previously filed with the commission in this docket?
Yes, I did.
Do you have any changes or additions to your pre-filed rebuttal testimony?
No, I do not.
If I asked you the same questions here today, would your answers be the same?
Yes, they would.
Did you prepare or cause to be prepared under your supervision 5 exhibits labeled as Bauer Rebuttal Exhibits 1 through 5 that were previously filed with the commission as an attachment to your testimony in this docket?
Yes, I did.
Do you have any changes or additions to the exhibits?
No.
Chair Belser, at this point, I would ask that the pre-filed rebuttal testimony of Mr. Bauer be entered into the record as if given orally from the stand.
Mr. Bauer's pre-filed rebuttal testimony will be entered into the records if given from the stand.
And Chair Belser, I further move that Mr. Bauer's rebuttal exhibits 1 through 5 be marked and entered into the record as the next hearing exhibit.
Mr. Bauer's exhibits 1 through 5 that are marked as rebuttal exhibits will be a composite exhibit marked for identification as hearing exhibit 46 and admitted into the record of this case.
Thank you, Chair Belser. And turning to you, Mr. Coyne. Are you the same Jim Coyne who appeared before the commission, I think, a week ago?
I am.
And Mr. Coyne, would you just state your full name for the record?
My name is James M. Coyne.
And by whom are you employed and in what capacity?
I am a Senior Vice President with Concentric Energy Advisors.
Did you prepare or cause to be prepared under your supervision rebuttal testimony of 51 pages that was filed with the commission on April 22nd this year in this docket?
I did.
Do you have any changes or additions to your pre-filed rebuttal testimony?
No, I do not.
If I asked you the same questions here today, would your answers be the same?
They would.
Also, Mr. Coyne, did you prepare or cause to be prepared under your supervision 8 exhibits labeled as Coyne Rebuttal Exhibits 1 and 2, Coyne Rebuttal Exhibit 3.1, Coyne Rebuttal Exhibit 3.2, and Coyne Rebuttal Exhibits 4 through 7?
I did.
Chair Belzer, at this time, I would move that Mr. Coyne's pre-filed rebuttal testimony filed with the commission back on April 22nd be entered into the record as if given orally from the stand.
Mr. Coyne's pre-filed rebuttal testimony will be entered into the record as if given from the stand.
And Chair Belzer, I would further move that Mr. Coyne's rebuttal exhibits, as previously identified, be marked as the next hearing exhibit as a composite and entered into the record.
Mr. Coyne's rebuttal exhibits 1 through 7, including those subparts as identified or sub-exhibits as identified, will be a composite exhibit marked for identification as hearing exhibit 47 and entered into the record of this case.
Thank you, Chair Belzer. And Mr. Coyne, just staying with you, did you prepare a summary of your rebuttal testimony?
I did.
Would you provide that summary to the commission, please?
I will. Thank you. Chair Belzer, Vice Chair Powers, and Commissioners, good morning. Good to be back with you again. As you'll recall from my introduction last week, I am a Senior Vice President with Concentric Energy Advisors with over 40 years of experience in the energy industry and consulting, corporate planning for an integrated energy company. And I began my career in regulatory and policy positions for the states of Maine and Massachusetts. I've testified on numerous occasions before state, federal, and provincial regulatory commissions in the U.S. and Canada on matters pertaining to the cost of capital for regulated utilities, including electric and natural gas utilities, transmission companies, and pipelines. In my rebuttal testimony, I updated my cost of capital analysis using the same 4 models that I described in my direct testimony, with the most recent market data ending in March. My prior analysis had market data through October. The 4-model average remained 10.5%, confirming my original 10.5% recommendation. I also responded to the evidence of Mr. Aaron Rothschild on behalf of the South Carolina Department of Consumer Affairs as it relates to the ROE and capital structure for DEC. One concern I have is his reliance on only 2 models, the DCF and the CAPM. Under normal market circumstances, this might not be so limiting, but capital market conditions remain unsettled. The cost of equity for regulated utility companies is being affected by several key factors in the current and prospective capital markets, including the interest rate environment and central bank monetary policy, as well as current inflationary pressure. In fact, interest rates are currently higher than they have been for more than a decade. An additional point of comparison that may be useful to the Commission is decisions of other regulators on the cost of capital for vertically integrated electric utilities. Based on the most recent decisions since 2022, the average allowed ROE is 9.8%. My recommendation is higher than this average, but we should bear in mind that these decisions were made when interest rates were much lower than they are currently, and one would expect allowed ROEs to notch upward as costs increase for all companies raising capital. And the equity ratio is consistent with the actual level maintained by the operating utilities and the proxy companies. Sufficient equity in the capital structure is an important factor for maintaining DEC's financial integrity and investment-grade credit rating, and it is an essential component of DEC's financial policies, enabling access to capital on favorable terms in a variety of market circumstances. It's immediately clear that Mr. Rothschild's recommended ROE is substantially below national averages, and in fact below any authorized return in the last 40 years, and well below those of the other witnesses in this proceeding. As I discussed in detail in my rebuttal testimony, his methods are flawed, unconventional, and lead to unreasonable results. His recommended 8.45% is out of alignment with any reasonable estimate of the cost of equity for DEC. That concludes my rebuttal testimony summary. Thank you.
Thank you, Mr. Coyne. And turning to you, Mr. Bauer, did you prepare a summary of your rebuttal testimony?
Yes, I did.
Could you provide that summary to the commission, please?
Sure. Chair Belzer and members of the commission, I am the Director of Corporate Finance and Assistant Treasurer for Duke Energy Corporation, the ultimate parent of DEC. I'm responsible for financing the operations of Duke Energy and its subsidiaries, including DEC. I monitor trends in the investment markets and maintain key relationships with debt investors, analysts, and financial institutions. I also manage Duke Energy and its subsidiaries' credit ratings and interactions with the major credit rating agencies, commercial banks, and the capital markets. My rebuttal testimony responds to the testimony of Department of Consumer Affairs witness Rothschild regarding the issues of the company's capital structure and credit quality. Intervener witnesses do not take issue with my comments in my direct testimony on the importance to DEC and to its customers that the company maintain its financial strength and credit quality. However, the recommendation of intervener witness Rothschild for DCA of a capital structure of 50% equity, 50% debt, in combination with his very low 8.45% ROE recommendation would be severely detrimental to the company's financial health, with an immediate impact to both the qualitative, the less constructive regulatory environment, and quantitative, weaker credit metrics, those factors the credit rating agencies use in evaluating DEC's credit quality. Witness Rothschild's recommendations would increase the leverage and the risk of the company, leading to reduced cash flows, stressed credit metrics, lower financial flexibility, and ultimately higher costs of capital, both debt and equity, to the detriment of our customers. I further demonstrate in my rebuttal testimony that Mr. Rothschild's proposed 50-50 capital structure is severely flawed, in that it is based on the wrong data. He relies upon parent company capital structures instead of looking to the utility operating subsidiaries' capital structures. This is an apples to oranges comparison, and if the appropriate apples to apples comparison were made, the results would show that the average common equity ratio for DEC's operating utility peers are comparable to the 53% equity ratio the company requested in this proceeding through my direct testimony. My rebuttal testimony also addresses the issue of the importance of continued deferral for future recovery of DEC's coal ash basin closure compliance spend. The spend, defer, recover model the company has followed since 2015, and both this commission and the North Carolina Commission have approved in multiple rate cases, has resulted in highly favorable treatment from the credit quality perspective by Moody's and S&P. Were the commission to reverse course, the resulting adjustments by the credit agencies would be detrimental to both the company and its customers. The company's existing strong investment-grade credit ratings constitute a form of insurance against downgrades that will be the likely consequence of weakening financials, and downgrades only work to the detriment of DEC and its customers. The settlement agreement represents a reasonable and equitable resolution of the issues, and I urge the Commission to approve this settlement and provide DEC the opportunity to maintain its financial health and credit ratings to the benefit of both the company and its customers.
Thank you, Mr. Bauer. And with that, Chair Belzer, Mr. Coyne and Mr. Bauer are available for cross-examination and questions from the Commission.
Thank you. Mr. Hall? And Mr. Hall, I believe you reserved your cross of their direct until today. Is that correct? Thank you.
Good morning, gentlemen. How are you today?
Good, thank you.
Mr. Coyne, I'm going to start with you. And I see it looks like you have your testimony in front of you. Is that right?
I do.
Okay. So if I get moving too fast, you want to check your testimony, please interrupt me and let me know.
I do.
Some-
And I have both direct and rebuttal
Okay.
and
Good.
supplemental.
Okay. I'm starting on page 8, lines 18 to 19 of your direct testimony.
I'm with you.
And there you state, regulated utilities rely primarily on common stock and long-term debt to finance permanent property, plant, and equipment. Is that right?
That's right.
When you say common stock, do you mean normal stock? Do you mean stock?
Common equity.
Common equity. Okay. And when you say debt, what do you mean?
Here I'm talking about long-term debt, and for a company such as DEC, it would typically be long-term bond issuances and similar securities that are used to finance the company's operations.
And you support DEC's requested capital structure of 53% common equity and 47% debt, correct?
I do.
What is the value of DEC's requested debt?
The value of its debt, do you mean by that do you mean its market value, or do you mean its rate of return requested in rates? Can you just tell me what you mean by value, please?
Either one. Well, let me show you. I'm actually going to look at Mr. Bauer's testimony.
Counsel, where are we? What are we looking at?
I am on your rebuttal testimony, page 31.
And this is Mr. Bauer's rebuttal testimony?
Yes. And so before I get into that, you asked about what I meant by value. What is the market value of DEC's requested debt?
My assumption is that, and Mr. Bauer is sitting here with me so he can verify this, is that the actual debt value that I see here, it looks like it's 16.3 billion. I'm assuming that that is the book value of that debt. And that's typically the value that's used for rate-making purposes, just as it is the book value of equity. When you ask what's the market value of that debt, in order to determine the market value, you would have to look at the market value for the individual securities and determining whether or not they're trading above or below par. But for rate-making purposes, we typically use book value, so we don't have to go through that process.
Okay. So I think your answer just said this, we can establish there is a difference between the accounting book value of debt and the market value of debt, correct?
There can be.
Okay. And as we see here, Mr. Bauer's rebuttal testimony, he shows $17.2 billion of debt for DEC, which this includes North Carolina and South Carolina. Well, I guess let me ask Mr. Bauer that. Mr. Bauer, the $17.2 billion, or excuse me, I have the number wrong, 16,387. Is that debt for North Carolina and South Carolina?
Yes, it's one company.
Okay, thank you. Okay, Mr. Coyne, back to you. What is the requested interest rate in this case?
4.56%, which is my understanding is the embedded actual cost of debt on the company's balance sheet that would relate to that 16.3 billion that we just looked at.
Okay, and is that rate reasonable?
It's the actual, and my understanding is that for most commissions, they look at the actual as reasonable from a rate-making standpoint if it is consistent with the cost of debt for peer companies and generally consistent with good practices in terms of going to market and raising that capital. Another way to look at it is if you look at the current cost of debt, and the current cost of debt for a BAA rated utility is currently 5.8%. So I would say not only is it reasonable, I think it represents a very good value for customers right now because it's below the current market value of debt. But it was raised over the course of decades, I presume, so it represents interest rates and values at the time that all that capital was raised. So I'd say it does represent a fair value for utilities on that basis, for customers and for the utility on that basis.
And so is the $16.3 billion value of the debt that we saw in Mr. Bauer's testimony, is that the same as the 4.56% interest rate?
No, they're different. One is a measure of the magnitude of debt, and the other is the average coupon rate that the company pays for interest on those securities.
I'm looking at your rebuttal on page 39, lines 4 to 6.
I'm with you.
And there you say, Mr. Rothschild's claim that, quote, the value of short-term U.S. Treasury bills has a relatively low exposure to swings in the overall market, end quote, is demonstrably false given recent history. Is that correct?
Yes.
Okay. Did you show in your rebuttal testimony that the value of short-term U.S. Treasury bills is exposed to swings in the overall market?
Did I show that the value is exposed?
Yes.
In my rebuttal testimony? I'm not sure that I have a chart on short-term interest rates in my testimony, but I can tell you from experience that the value of short-term securities has gone from, it's followed the arc of federal government policy on setting short-term interest rates, and it has gone from near zero during the depths of COVID to prices over 4% and close to 5% over the course of the last several years. So that's a lot of volatility. I don't need a chart to be able to recount that.
But those are interest rates you're talking about, right?
Yes.
But you did not show how the value of these bonds have changed over that time?
Well, I'm speaking to, he's speaking to value, I'm speaking to interest rates. He's using interest rates in his analysis for 3-month Treasury bills. And that's the issue that I'm really taking issue with. Such a volatile measure as 3-month Treasury bills, in my mind, is inappropriate for setting the cost of capital for a regulated utility that's relying on long-term debt and equity for purposes of financing its operations.
But
The value of short-term securities typically stays relatively stable, but it's the interest rate that fluctuates significantly.
Okay, but Mr. Rothschild did in his rebuttal on page 7 give an example of that. Do you recall?
I do.
And he stated that the value, $1 million face value, if interest rates change from 0.08% to 4.5%, 4.53%, the loss of value for a 30-year Treasury bond would be over $700,000, while the loss of value for a 3-month Treasury bill would only be $11,000. Do you recall that?
I do, and that would all be well and good if Mr. Rothschild were using the value of securities in his analysis, potentially, but he's not. He's using the interest rates on those 3-month Treasury bills, and that's the problem that I'm taking issue with. It's not the right security, and the measure of the interest rate on that security is problematic. For a company that's financing assets with lives that are, as we heard in testimony yesterday, talking about transformers, this utility is financing assets with lives of 40 years or longer. And why would one use a short-term interest rate to measure the cost of capital for that utility? That's the part that doesn't make sense to me.
So I'm looking at page 17, figure 3 of your direct testimony.
Mr. Hall, I hate to interrupt. Is that microphone on? I'm really
Yeah,
having trouble.
I have a problem sometimes getting it close enough to me. Is that-
Okay,
is
I
that
know you're
better?
tall, so thank you.
All right, you're welcome. Mr. Coyne, I'm looking at page 17, figure 3 of your direct testimony. I'll put it on the screen for everyone.
I'm with you.
Okay, and this figure shows, oh, let me get it, wait for it to come up. So this figure shows that the Federal Reserve's target federal funds rate increased from near 0% in 2022 to a 22-year high of 5.25 to 5.5% through December 23. Is that correct?
That's right. That's the very problem that I was speaking to in terms of the volatility of short-term interest rates during this period.
And so it's still at that level?
Yes.
And long-term interest rates have increased over this time period, you mentioned, right?
Considerably, yes.
And on page, let me see if I've got this one. Don't think I have this one, but I think on page 18 of your direct, you state, as seen in figure 4 below, for the first time on record, the yield on a 10-year Treasury bond dropped below 1% in March 2020 and touched an all-time low of 0.318%. As the Federal Reserve has tightened monetary policy and concerns for inflation have grown, long-term interest rates have rebounded sharply to over 4.6%. Is that correct?
That's right.
So are you saying that the interest rate on the 10-year U.S. Treasury bond increased from 0.318 to 4.6? I got that right?
0.318 to 4.6, yes.
How much did the value of a 10-year Treasury bond change over that time period?
Well, I don't have data here on the value of those Treasury bonds, but it fluctuates as the interest rate fluctuates. So you would have expected a lot of fluctuation in the value of those bonds during this period for the reasons we just discussed. There's a lot of uncertainty around inflation during this period, and with questions around inflation, you'll see valuation in the value of bonds move in the opposite direction from interest rates. So you would expect as inflationary pressures are increasing, the value of a current bond would decrease and vice versa.
Okay. And that is essentially what Mr. Rothschild was showing in his Sir rebuttal, that statement I read earlier, right?
You'd have to be specific about which statement you mean, but if the question is, do the value of bonds fluctuate with inflationary pressures, the answer is yes. And that is one of the issues we face when looking at the cost of capital, is that you need to look at both current and forecast bond yields, but of an appropriate tenor. 10 years would be the minimum that I would consider for a utility. I would defer to Mr. Bowers on this, but I think that he would describe the types of securities that he's raising for Duke to be typically of yields that are 10 years or much longer. Some utilities issue debt that has 50-year maturities. So we're looking at a measure of the cost of capital for the types of debt and securities, both debt and equity, that a company needs to raise to finance its operations.
Thank you. I'm going to move to page 40, lines 14 to 15 of your rebuttal.
I'm with you.
And there you state, Mr. Rothschild failed to address some of the fundamental concerns cited in the research surrounding option-implied betas. Is that right?
That's right.
You go on to say on that page at lines 17 to 19 that the authors of the research cited by Mr. Rothschild suggest that 6 months may not be the appropriate time period to use when estimating the cost of capital. Is that right?
That's right.
And further on lines 22 to 23, you have a quote from that research that states, quote, for other applications such as the cost of capital calculations, longer horizon betas may be needed. Is that right?
That's right.
So are you claiming that Mr. Rothschild's cost of equity recommendation does not account for time periods beyond 6 months?
His option implied betas are limited to an average 6-month period. And the reason they're limited to that time frame is that's the, as he describes, that's the length of data over which options are available to him in this analysis. So he has an average, some of his data is shorter than 6 months. I believe the average is 6 months.
Do you have Mr. Rothschild's testimony?
I do. Yeah.
I'm going to put it on the screen, but I'm looking at page 76 of his direct.
I'm with you.
Okay, so here, the highlighted part that I have on the screen, it says, because of these changes across option expiration periods, I take a weighted average of the entire term structure of the option implied volatility and skewness, which for the S&P typically goes out to 54 to 61 months, interpolating where necessary and giving the most weight to the option period expiration period of 12 months. Do you see that?
I do see that. Yeah.
So would you agree Mr. Rothschild does consider time periods beyond 6 months?
Well, okay, let's break it down. If you look at Mr. Rothschild's analysis, he uses option implied, he derives option implied betas 2 ways. For the companies in the proxy group, he relies on 6 months of data, right? That's what I thought you were referring to, and that's when you look at the testimony, my testimony you were quoting, that's what I was speaking to. When he looks at the entire market, he has data here on skewness that goes out 54 to 61 months. That's a different issue. So he uses several different measures of options depending upon the available data in the market. My criticism is that when he's looking at only 6 months of data for the utility proxy group, that's an insufficient time period, and the data itself creates problems when you're looking at it. If you look at the data that he has available to them within that time period, both create issues and challenges to his approach. And in my view, make them unreliable.
And so, given that you're concerned that Mr. Rothschild did not address the issues in the research paper you quoted, did you determine what his cost of equity result would be if he had used option data with a time period longer than 6 months?
Not possible. He doesn't have it available because it's not available in the market, as he says in his own testimony. And that's one of the challenges. You know, it's an academic paper that suggests something that's interesting, and if you had data available longer than 6 months, that it might be more useful for purposes such as we are using it here today, and that is for the purposes of determining the cost of capital for regulated utility. The authors of the paper themselves say that it would be desirable to have data that were available over a longer period for that purpose. The data is not available to him, therefore he could not use it, and therefore in my estimation, we don't have a reliable estimate.
Were you here when Mr. Mehta cross-examined Mr. Rothschild?
I was.
So you're aware that he showed him documents, a governor's executive order, some census data, Department of Commerce, and Act 220 from the South Carolina legislature?
I followed that, yes.
Okay. Did you consider those documents in your ROE analysis?
As direct inputs? No.
No. Okay. Did you hear me talk to Mr. Callahan last week?
I did.
And so you're aware that DEC did not come in for a rate case from 2000 to 2002?
From 2000 through 2002?
Are you aware that DEC's last rate case was in 2018?
Yes, they've been out for 5 years, is my understanding.
And so they did not come in when the interest rates were at near 0% from 2000 to 2002?
When you say when interest rates were near 0%, that was for a short-term interest rate. And as we discussed, the embedded cost of debt for the company is 4.26%. You wouldn't expect a company's cost of debt to mirror what's going on with a short-term Federal Reserve rate. It has much more stability to it than that because of the tranches of debt that are issued with terms that are expiring over 10, 20, 30, 40-year periods. So you wouldn't expect DEC's cost of debt to look like the chart that we just reviewed showing the short-term interest rate trend. But I'm aware that they stayed out for 5 years.
And in your summary, so I assume it's in your testimony too, you said that the market remains unsettled. Is that right?
That's right.
And the ROE in this case will be DEC's authorized ROE until it decides to come back in for a rate case. Is that right?
That's my understanding. And as if I can opine on that a bit, and I've thought about that. And as I consider the settlement, if I could just discuss that for a moment, where the proposed ROE is 9.94%, in my view, that settlement ROE is below the market cost of equity for DEC right now. And the fact that it would stay out prospectively for multiple years with a cost of equity that's below the market debt today, when we know that interest rates and cost of capital are increasing, to me makes it a very favorable compromise in my view from a customer perspective. But the company has said it believes it's fair, but that is one of the considerations I think for the commission, is that it would have a stable and below market ROE for the settlement period in my view.
But regardless whether the market settles, gets better, gets worse, inflation goes up or down, interest rates go up or down, the authorized ROE will be set until DEC decides to come back in. Is that right?
That's right, yeah. And because of all the trends being on the upside, I would say that represents a pretty good hedging strategy from a customer standpoint.
Thank you. That's all the questions I have for you, Mr. Coyne. Mr. Bauer, I do have a few for you. And I'm start with your direct testimony. I'm looking at page 2.
What page did you say?
I'm sorry, page 2.
I'm sorry, Mr. Hall, page
2.
2. Thank you.
Got it. I'm there.
Okay. And there it just says that you're employed by Duke Energy Business Services, and that you provide that Duke Energy Business Services provides various administrative and other services to Duke Energy Carolinas, DEC or the company, and other affiliated companies of Duke Energy Corporation, Duke Energy, correct?
Correct.
And you continue on page 3 that stating you're responsible for financing the operations of Duke Energy and its subsidiary utilities, right?
Right.
And it says this includes the issuance of new debt and equity securities and obtaining other sources of external funds, correct?
Correct.
Okay. So when you say obtaining external funds, are you talking about from Duke Energy, the parent company? Or who are you referring to there in that statement on page 3?
All forms of capital raising falls under my jurisdiction, right? So I issue debt and debt securities at the operating companies, and I issue all forms of securities at the holding company.
Okay. So when you say you raise equity, you're raising equity for Duke Energy, the parent company, right?
That's right.
Okay. Yep. You only raise debt at the subsidiary level?
That's right.
Okay.
There's no publicly traded stock of Duke Energy Carolinas.
Right. So I'm looking at page 4 of your direct, and you state, and I'm sorry, I don't have the line number, but just tell me if you think I'm mischaracterizing your testimony. You state that DEC faces substantial capital needs over the next several years as it continues the energy transition. The company competes for capital in the open market and must appeal to debt and equity investors to attract the capital needs. Is that right?
That's right.
Okay. I'm skipping over to page 24 of your rebuttal.
I'm sorry, Mr. Hall. Number again.
I have not given a page number yet. I'm just letting him get to page 24 of his rebuttal.
I'm there.
Roughly around line 4. You state authorized ROE is of paramount importance because it drives a company's ability to earn a return on invested capital and share the return with equity investors. If the commission were to adopt one of the intervener witnesses' ROE recommendations, it would negatively impact DEC's ability to attract debt and equity capital in reasonable terms, especially in times of financial stress or under volatile market conditions. Does that sound right?
That's what's written. I believe it.
Okay, and I discussed some of this, similar statements with Mr. Callahan. Did you hear that?
Yes, I was here.
Okay, and so can we establish that Duke Energy Corporation is Duke Energy Carolina's equity investor?
I wouldn't say that they're an well, they own the equity of Duke Energy Carolinas. Common equity is issued at the parent company and when needed, infused into the utility subsidiaries.
And we established that because DEC is not publicly traded.
That's right.
Right, okay. And your language, at least on page 4 of your direct, was a little bit different than Mr. Callahan's, but when you say the company competes for capital in the open market, are you referring to Duke Carolinas or Duke the parent?
I'm referring to both. Duke Energy Carolinas competes for capital in the debt capital markets. Duke Energy Corporation competes in the equity capital markets.
I'll look at your rebuttal, page 36.
Okay, I'm there.
And on that page, you talk about the risk of a credit downgrade. Is that right?
Yes, I do.
And you talk about that in terms of increased cost of debt.
Yes.
And I discussed with Mr. Callahan, but correct me if I'm wrong, that debt investors include entities that buy bonds, right?
Right.
So there's be insurance companies, banks, pension funds.
That's right.
Okay. And on page 36, lines 10 to 14, you talk about bond prices, right? You say...
I do. I talk about the interest rate impacts of a downgrade.
And that's what we're talking about when you're talking. Just want to establish that. We're talking about credit downgrades. We're talking about the interest rate going up on your bond issuance.
And I would assume to pay a higher interest rate if the credit were to be downgraded, yes.
Okay. And so you provide general concerns, but the quantifications you provide show that consumers would be better off if Mr. Rothschild's recommendation is used to set rates, right?
I think that that's a mathematical exercise that when you manipulate a formula, and I followed your formula in Mr. Rothschild's testimony, that in the very near term, yes, there would be a benefit to customer rates if the company suffered a downgrade only because of a lower ROE. I think that was the argument that Mr. Rothschild put forward, and I would agree with that. Math in the near term would cause lower customer rates.
And that's all just a function of that equation. That
It's all a function of the equation.
The ROR is
a mathematical exercise. That's correct.
Right. So whether the interest rate goes up 100 basis points, the ROE could balance that out and essentially lead to a lower ROR, right?
The statement that you're making is mathematically correct. Practically speaking, I think it's very hard to try to determine exactly what the benefit to customers would be over the long run. I think that if you were to lower the ROE to where Mr. Rothschild's recommendation is, I think there's a lot of consequences to that. And I think it moves well beyond just an assumption and a mathematical formula. I think the ability to attract capital is severely impacted, both debt and equity. I think you can look at basis points, and you can look at basis points in a bond yield and say, you know, if we take a one-notch downgrade, perhaps maybe it's 10 to 20 basis points in a regular market. In a very volatile market, maybe that spikes to 30 to 40 basis points. And that happens. And, you know, when we talk about, and how Mr. Callahan talked about the significant capital expenditures of this utility over the next decade, just over the next 5 years, we have a $24 billion capital plan. I have $2 billion of debt that I need to refinance. And so if you think about that, I'm going to refinance and issue new debt securities somewhere between 12, 13, 14 billion dollars over just the next 5 years. And that's before we start building new generation. So what happens when you do this is, yes, in this rate case, mathematically, you could lower customer rates. But over the long run, as you're issuing all of these securities that help build that very favorable 4.56% portfolio weighted average cost of debt, then all of a sudden that starts moving higher and higher and higher, and customers are going to pay that for 30 years. And so you could make a very short-term decision today to say, lower the ROE, harm the company's cash profile, erode the credit rating of the utility. And I can get into the fact that that doesn't just happen and you get an upgrade when things look better. Downgrades are near permanent, especially in a capital intensive company that's cash flow negative. An upgrade is very rare. So if you do suffer a downgrade, you should expect to hold that downgrade for a very long time. And that becomes a very slippery slope. And so all of this to get back to say, yes, in the very near term, that math would lower customer rates. But over the long run, all of the debt that we're going to issue is going to be set at a higher rate for a very long period of time. And so the customers today may benefit from lower rates out of this rate case, but the children and the grandchildren of the customers today are going to be paying that higher cost of debt for a very long time. Then all of the debt that's in the portfolio, the $16 billion of debt that I have out there today with a weighted average life of 15 to 16 years is all going to have to be refinanced as well at a higher rate. And so once you start degrading a balance sheet, like I said, it's a very slippery slope, and a one-notch downgrade can quickly turn to 2, can quickly turn to 3, because when is it enough? When does somebody say, okay, we've levered up enough? And then you've kind of gone too far. You're in a spot now to where even if you wanted to reverse course, you couldn't, because the upgrade threshold is so much higher than a downgrade threshold. Just to get back to, if we suffered a downgrade in this rate case, and I wanted to say, we looked at it in the next rate case and said, you know what, we were better off at an A2. Now we're down here at A3, cost of debt has moved higher, it's hard on customers, we would like to get that credit rating back. You wouldn't be able to. You'd have to go back and reverse course on the ROE, make it much higher, change the capital structure to put more cash flow into the utility to try to salvage that credit rating that you once enjoyed. So I think there's a lot, and I just wanted to give a little bit more perspective to the commission that levering up and using the company's balance sheet as a lever to try to lower customer rates should be thought more of strategic and not just as a lever in a rate case to say, how can I shave a few cents off a customer bill?
And I understand that. Let me ask you, so you're saying that customers are going to pay that debt rate for a long time. Customers also pay the equity rate, correct?
They do.
And that will, all the building you're talking about, that increases rate base, correct?
That's correct.
And so the higher the ROE, the more customers are going to pay on that rate base and all that building for as many years as you're talking about, right?
Right, but that higher ROE also attracts the capital that the company needs to make the investment to build the rate base. It all goes together, and I think in this very simplistic model, I think you're solving for one thing, and you're solving just for customer rates. And that's, I'm not going to say that's an easier job, but the harder job is to say, how do you solve for reasonable customer rates that are fair to the customer, but also meet the equity investors' needs and also protect the balance sheet, which protects the creditors who loan money to the company. And so I've got to solve for 3 things, not just one thing. And so we've got to think about what's fair. And if in this example you say, lower the capital structure, lower the ROE, give it to customers. That's, to me, that's very unbalanced and unfair. So I'm in a very unique position here at the company. You've heard from a lot of witnesses here that are very focused on customers. We heard from the transmission and distribution guys that are trying to keep the lights on as reliably and safely as possible. They're very focused on customer service. I have a unique seat where I actually sit down and I interact across the table with the equity investors, and I understand what they need and what they want and demand of the company. I also sit across from lenders who loan the company money for up to 30 years, and they want stability. They want to invest in a utility that's not going to move all over the place. People don't invest in a utility for volatility or for significant growth. They want stability, somewhere where they can put money away for a long period of time and earn just a slightly higher yield than they could in a government bond. And that's what they look at a utility, and that's our role here is protect the balance sheet, provide equity investors with an opportunity to put money to work and earn a fair return, and at the same time, try to keep customer bills as manageable as we can. That's our objective.
And I appreciate that. And in your testimony, you do talk about, you had mentioned, 1, 2, 3-notch downgrade just now. Very slowly in your testimony, you say that a 3-notch downgrade is about a 20 basis point increase in cost of debt, right?
Again, I think that you have to look at the trend of the utility, and the market will set what those basis points are. If you looked at just the rating differential between a current rating and 3 notches lower of a very stable utility, you can see in a very favorable market where things are not very volatile, it's still a strong investment grade rating, but there's a differential in there of credit spread. We could see during COVID, we could see during the banking crisis that we had last year. We see it when geopolitical risk shows up. We see it around election time. There's a lot of volatility that comes into the market. Those credit spreads widen because investors perceive more risk. And for a lower rated utility, they would expect a higher return. Yeah. And so a multiple down, but it all depends, right? So if you come out of a rate case hearing and the commission changes course and says, we're going to lower the ROE by 200 basis points. We're going to change the capital structure to lever up the utility. From an investor's perspective, they may say, no thanks. And so then all of a sudden supply and demand comes into pricing the bonds, and it may be something much different than 30 basis points. So that's what I want to say is you can look at a chart and you can just look at the bond index yield between two different rated securities and say, well, there's the difference. But I would say the trend of the utility will also add to that difference.
And I think you touched on this. There are a lot of different factors that go into bond issuance spreads. Would you agree?
Oh, absolutely.
Yeah. The size of the offering can make a difference. The timing, you mentioned that. The name value or recognition of the utility company.
Yes, I agree with all that.
Thank you. Give me just a minute. I might be able to skip a few things. So I'm looking at page 7 of your rebuttal. And I'm sorry, I do not have a page number, but if you just generally agree that on that page, you state it's inappropriate to compare DEC's capital structure to the parent level holding companies?
Yes, that's true.
Okay. And on lines 20 to 23 of your rebuttal, you state that the holding company capital structures differ from regulated utility operating company capital structures for a variety of reasons. And the risk profile for a consolidated entity can be very different than the risk profile of a single subsidiary, correct?
Yes, that's true.
Do you agree? I believe in your rebuttal exhibit, I think it's 1, it was the Moody's report from May 11th, 2023. And Moody's states that DEC's credit reflects its, quote, low operating risk profile.
Yes.
Okay. And so Witness Coin's proxy group that he used in his cost of equity calculations includes holding companies, correct?
I believe it does, because that's where the common equity is issued. And so that makes sense that for an ROE analysis that he would use a holding company.
Okay. Do those holding companies have unregulated operations?
I'm not certain.
I guess I'll ask Mr. Coyne. Is that part of your criteria?
Getting back on. As you'll recall in my direct testimony, I screen according to regulated operating income and electric operating income and assets for those that have the vast majority of their operations are in regulated utilities. But some of them still have regulated operations at the holdco level. You can't eliminate them completely and still have an electric utility proxy group. So there are some, but I minimize them by screening for the vast majority being regulated operations.
Okay, and just to confirm, one of your criteria was that the regulated revenue and net operating income make up more than 60% of the consolidated company's revenue?
That's right, and then 80% of that in the electric utility business.
Okay. So, Mr. Bauer, given that, in other words, these companies in the proxy group could have up to 40% of their revenues and net operating income from unregulated operations. Would you agree?
I would, if Mr. Coyne said it, I believe it.
So, Mr. Mehta asked you at the end of his redirect about how credit agencies would view the settlement, and I believe you said that they would view it very favorably. Does that sound right?
Yes.
Okay. And I think you said likewise, if there was a change to a settlement, I think they could take a different view. Does that sound right?
That is true.
Is it also true that on Friday, May 17th, before this hearing started, Duke Energy Carolinas had a press release about the settlement?
I was here in the room.
You're not aware that Duke had a press release about the settlement?
I'm sure they did. That's a material development with the company.
Okay. And so, you aware that it included some of the terms like the ROE and the cap structure, the EDIT mitigation?
I did not read the press release.
Okay.
So I can't speak to it. I'm sorry.
But I'm just wondering, given that, we're concerned about credit rating agencies and how they might view the company, and they might not take a favorable view if it were changed, are you not concerned about the credit rating impacts from putting out a press release if then the settlement gets changed?
No. In my interactions with the rating agencies, I think that this is due course. I think that these rate cases, they're all different. They all play out differently. We do have conversations with the rating agencies throughout. How's it going? There's things that we can talk about, and there's things that we can't talk about with them. Generally, they ask a lot of questions. As when I get off the stand here, they'll ask me, what was it like? What was the tone in the room? How did it go? What were your feelings? Because they think about the jurisdictions. They think about the commission. They think about the environment, our ability to work constructively with interveners. To be able for the company to put out a press release, and I can't speak for our corporate communications department, but for them to put out a press release that says, hey, the majority minus DCA, we were able to reach a settlement agreement. That's just providing an update to a very material piece of news for the company for the year.
So you stay in touch with the credit rating agencies a lot, you said, right?
A lot, yes.
And so you talk to them and you provide input on your opinion of regulatory environments?
Yes.
So do you say it to some extent then they're not independent assessments?
They're absolutely independent assessments. They're just gathering data points. Where they will ultimately make their determination of the constructiveness of the state will be when they read the order. That's what it's based on. Sure. But sometimes you can read an order and it's hard to determine, what was the dialogue like. So oftentimes they're curious and they're asking. I think that it's S&P, not Moody's, that has the subsidiary RRA. That's completely independent. I've never talked to anybody at RRA. And RRA puts out a strong rating of different jurisdictions across the country.
Okay. That's all the questions I have. Thank you.
Thank you, Mr. Hall. Commissioners, Vice Chair Powers.
Thank you, Madam Chair, and good morning, guys.
Good morning.
Morning.
It's a real education for you to explain these things, and certainly, Mr. Bauer, you're very passionate about your job. You've listed so many factors about how the credit ratings and cost of debt, things involved with that. And it's kind of like a friend of mine said, when I put some money in the stock market, it's crapshoot, some of it. And I admire how you could possibly keep up with all that. It's pretty amazing. One thing that kind of came up in the testimony just then that I had thought about a while back is this press release. Obviously, some of it's based on information that you know or you obtained. You had nothing to do with any sort of press release?
No, sir.
Would the company have your information to create a press release or your opinion about capital structure or debt?
Yeah, and again, it's I think the press release was probably factual, but I'm saying probably because I didn't read it. But I'm assuming it was just an update for the investment community of what the terms of the potential settlement were.
Okay. You also, you used the word detrimental, that a lower cost of debt would be in the long term detrimental to customers. And, we've had these public hearings and we've heard from, God, I don't know how many customers. Wouldn't it also be fair to say that a higher bill is detrimental to the individual customer?
Yes, I agree.
Okay.
I'm a Duke Energy Carolinas customer.
Okay. and you've done a lot of work as far as stability. Does it help as far as credit rating and as far as you're dealing with all these different people? Does it help to have a strong parent company behind Duke Energy Carolinas?
It does. It does. I would think of the parent company as a pressure relief valve, right? And so, bear with me here. It's, I've got children, and I'll liken it to this because it's a parent-subsidiary type relationship. And so, before we had children, we lived in an apartment, and we had no debt. When we started a family, we needed to take on some debt to help support the growing family. We bought a house. As my kids get closer to college age, I've got to fund that. When they turn 16, I've got to buy a car. I mean, there's a lot of things that go to help them through their growth. Maybe it's not a great example, but that's the way that I think about it. Is a parent, a strong parent, to be able to support that growth is very important in the same way. If you look back in time, Duke Energy Corporation had no debt on its balance sheet. As the utilities entered into a growth cycle that we're in now, and a lot of that just has to do with strong economic development in the Southeast. There's a lot of very good investments that we can make in these utilities to modernize the system, to build, to attract new people, new economic development into the state. And by doing that, we have to finance at the capital structure that's awarded us by the commission. And there's times that the subsidiaries can't quite pay their dividends to the parent because they're investing heavily in their utility. And at that time, the parent may have to go fund itself for a while and not rely on those dividends up. So, keeping that balance sheet strong across the whole system is incredibly important for us to achieve the objectives of trying to get through the next 10 years of rebuilding aged infrastructure, adding new customers to our system, and trying to attract new capital investments and others to the state requires a very strong balance sheet at not only the utility, but also at the parent company.
Your example is a great example. I got 3 children. And before we had children, I had a BMW convertible. That went out the window. Are you able to assign any value as far as having a strong parent company? Not necessarily points, but anything to that?
It would be hard to say that I could ascribe a value and then try to point to something to prove it. But what I can say is that when Duke Energy comes to the market, whether we're selling common equity at the holding company or we're bringing the utility subsidiaries to the market, it clears the way. It has a very, very strong presence when we come to the market. And so I would just say that what we have currently, it works very well. And that's what I try to, say and try to educate the commission from my point of view when I come and I serve as a witness is what we have today, it works very well. It works at the utilities, it works for the holding company, and what I just don't want to see is a disruption to that.
And you educated me very well. When you talked about volatility, they say COVID's still with us. Do you consider it still one of the volatile factors? Or
I think that I wouldn't call it COVID any longer. I would call it persistent inflation from COVID. That's what's with us today.
Okay.
And so when I look at the markets today, it's interesting. Mr. Coyne and I were talking about it over breakfast is, you look at things that you would think would really swing the market, but today the market hangs on every word that Jerome Powell speaks. And it's all about what is the economy doing? Are we in a recession? Are we not in a recession? Will it be a soft landing, a hard landing? When will the Fed reach their target of 2% inflation? As soon as that data starts to spike back up, the market, reprices because the expectations for future growth are so dependent on how companies can use leverage to grow their operations. And if interest rates are going to stay higher for longer, which is the new message and theme in the markets, then that dampens future expectations for equity investors. And so, yes, we are in a highly volatile time, and I would say that it's driven mostly by, now it's the inflation, which I would say stemmed from the COVID pandemic.
There's a lot of feeling among what I call normal people that a lot of the volatility in the market is manipulation by those who can. And I think we've seen that with some of the recent arrests and things that have happened over the last few years with different companies. Mr. Coyne, you talked about the 9.94, that you feel like that is a big win for the customer.
Oh, yeah, I wouldn't describe it as a big win, but it's below it's below what I consider to be and estimate the market cost of equity. And, you know, I look at surrounding utilities such as Florida Power and Light and Georgia Power that have ROEs of 10.8 and 10.5%. And I view them as being similar operators to DEC because they're companies that are managing utilities with nuclear power generation fleets and strong growth environments in the Southeast, as characterized by Mr. Bauer. And so it's a mixed blessing for utility to be in the Southeast because economic growth is a good thing for utility, but it also means a continuous need to invest.
Well,
And
you know, it's kind of funny. I have a house down at Beaufort, and somebody down there said, you know, nobody retires or moves up north. Everybody's coming here. I've always thought recently that a lot of the Georgia would be higher because they really overspent, but continued to pursue the nuclear project. Doesn't that have a big effect on their number?
well, their legislature and their commission has stood behind them with that very challenging project. Georgia Power still has very favorable rates, and as a result of that, customers seem, in my view, you know, having attended their hearings recently, seem to be very happy with the service that they're getting and the rates that they're being provided by their utility. So it's they reached a settlement at that 10.5% rate of return, and they'll be out for, I believe it's a 4-year period, if memory serves me right. It's either 3 or 4 years. So at a rate, and to your question about the big win with the 9.84%, I compare that to 10.5% for Georgia Power or 10.8% for Florida Power and Light for a similar utility. And in that sense, I would certainly describe it as being very fair and very reasonable from a customer perspective.
Okay. Well, unless I heard wrong, we've been told and during this hearing that the national average is 9.8, and this would be, what, 14 points above the national average?
That's right, but bear in mind that's the national average over the 2-year period from 2022 through 2023. And in that period of time, as shown in my multiple exhibits, we can see that interest rates have gone up steadily. Right. So it's a lagging indicator of what the cost of capital is for a utility.
Okay. And one other factor, Mr. Bauer, you mentioned about volatility was we're at election time. And that obviously is a real consideration.
Yes.
Well, there's a jury out now that could affect the election. Kind of waiting to hear from.
The markets will respond as soon as there's a verdict.
How will the market, what would be your guess as how the market would respond to guilty or not guilty?
Flip a coin.
You're not going to touch that?
No.
Okay, thank you very much. That's all I have, Madam Chair.
Commissioners? Commissioner Thomas?
Thank you. Good morning.
Good morning.
So let me start with you, Mr. Coyne. So you had made a comment about Mr. Rothschild only using 2 methods in his calculation. But Ms. Perdue only used 1. And any thoughts, comments, concerns about that?
I respond to that in my rebuttal testimony. I have a concern with both for that purpose. Ms. Pardue, in fact, used two models. She used the DCF and the CAP-M, but she didn't only relied on her DCF results, as I recall. And as I described to you last week, I guess it was on Friday, if memory serves me well now, I think there are real advantages in the types of markets that we're in right now, and I think Mr. Bowers categorized them well, is that multiple perspectives enable you to look at it through multiple lenses, and you can see extreme results coming out of any one of these models. And if you have approaches that are tried and true that you can use for that purpose, then you're better off, and you're less apt to make a mistake or end up with an outlying result. So I like the comfort of using a four-model approach, testing for a reasonable center point around it, and in this case, the mean, which for my results is 10.5. But you can get to a reasonable result using the DCF or the CAP model in combination, but you need to be that much more careful about the inputs to the models. And specifically in the case of Mr. Rothschild, it's the inputs to the models that I take issue with more so than his use of those two models per se.
Okay. And looking at the results from ORS, Consumer Affairs, and the company, and the range, so the range from ORS was only 21 basis points. It was like 9.73 to 9.94. And the Consumer Affairs range was 1.02%. The company's range was 1.59%. That's a very, very big difference. And you've talked about judgment and so on and so forth, and I think that you used the term informed judgment. So do you, I mean, to me, that ORS, just the 21 basis point range, I have a hard time seeing how anybody's informed judgment can be that good. Any thoughts on that?
Commissioner, I'm not sure which ranges you're referring to, because I think in the case of both witnesses, they had their mathematical range and then they had their recommended range that came from those results. When I look at the mathematical range for ORS witness Pardue, it was 8.39 to 9.97. So that was the mathematical range from her results. And for DCA witness Rothschild, it was 7.43 to 8.45. And so a little bit broader than the one you're referring to. So your range may be referring to the recommended range from within those results. But I think you've pointed to the very issue that I'm concerned with, is that each of these models will give you a range, and then if you use multiple models, they will give you a range on top of that. And by quantifying them using four tried and true approaches, you can begin to look for center points within that range. And that gives me much more confidence that you're ending up with a reasonable result, especially when you have market conditions such as we have that can give you a lot of volatility. And if you combine that issue with some of the unorthodoxy, I would describe it with, specifically with Mr. Rothschild's approach, you can end up with very low numbers in that range, and therefore you don't have a reasonable result to choose from. And I believe that's the position that he is in.
All right. So, Mr. Bauer, you probably were here, I guess it was yesterday, and I was talking some about risk and the nuclear being considered a risk factor by the rating agencies. I don't think I made that up. I can't remember where I read or saw or heard about that. Is that something that was in your testimony?
No, I don't talk about the rating agency's view of risk, but in this Moody's report that we continue to reference, they do talk about it. They just a few years ago, they put a new section in the back of their credit opinions called the ESG considerations, And back there, that's where they look at all the different risks and try to quantify things, or put a little bit more color around it. And I do believe that in one of these sections, they do talk about, under environmental, that section, they do call out nuclear as a particular risk factor. It didn't change their assessment. They just called it out and said, this is how we view the operating risk profile of the utility.
So that was not specific to Duke. That was just kind of a factor that they put
Just
in
a
the back
factor.
in their
That's right.
notes.
Yeah.
Okay. And I guess again, my thought is so, I mean, to me, the coal and natural gas have risks as well, particularly in the environment that we live in today with, the fossil fuels and that kind of a thing. Is that something that you talk with the rating agencies about?
We do. When we talk about it, and it's actually in here, they call it carbon transition risk. That's how they talk about fossil. Leave nuclear aside. When they think about the higher carbon emitting resources such as coal, that's really what they're focused on. They do see a risk there, but the risk that I would say, Commissioner Thomas, is more around end of life risk. Could you potentially get to the end of the life of one of these coal plants and find some stranded asset value there that potentially couldn't be recoverable? That's really the risk that they're talking about when they talk about fossil fuels.
Okay, so the settled capital structure, the equity was 51.21%, and basically there's been some comment about the company issued a lot of debt shortly after the filing was made, and so do you think that that's a reasonable settlement given it was a significant, I can't remember, I think it was $4 billion perhaps that was issued.
Wasn't quite that much. It was $1 billion.
$1 billion, okay.
But it's once you get that many commas, it's all big numbers. What I would say, and I tried to talk about this during my direct, is the capital structure moves every day. What I've found is a winning playbook for how to finance this utility is, in an effort to try to create demand with investors, I try to bring to the debt capital markets one issue per year from this utility. By doing that, I create pricing tension and I'm able to drive the cost down as low as I can. And I do that for the benefit of customers only, right? It's a cost of debt that's passed through directly to customers. But I found that works much better than breaking up that $1 billion into, let's just say, 4 tranches of $250 million each. Because what would happen is if I did that, and I came to market with a $250 million bond offering, if the market is not favorable on that day and investors said, you know what, not today. I know you've got 3 more to do over the course of the year. I'll pick up one of those later. Then what happens is I never create pricing tension in any of the 4 transactions. And so I've learned that if I do it one time, it's better. What I've also seen, and there's a trend in the market, and it's just the way that I've seen it, is that interest rates tend to rally as you go in towards the end of the year. And so, some of that could be investors that are just de-risking their portfolios. They're selling equities. They're buying government treasuries. It's pushing the rates down. And so what I like to do is I like to come out in the very little window that I have available to me in January. And I've done it the last 5 years in a row at Duke Energy Carolinas, as I've issued that bond deal in January. And so, took a little bit of offense to the, I think the word manipulation was thrown in there, and it was not the case. The case is that, we had a capital cutoff date for the rate case, but my playbook over the last 5 years, even when we didn't have rate cases, was try to take advantage of that limited market opportunity that I have based on falling U.S. Treasury rates. Credit spreads were at a very tight level, and so the market was primed. It was ready. Investors are ready in early January to put money to work, and I came with the biggest offering that I had for the year of any utility, which was Duke Energy Carolinas, and I secured an incredibly low rate at the time for customers.
Okay.
So, all of that to answer your question is, yes, so that changed the capital structure immediately following that debt issuance, but that's the only debt issuance I have for the year. So mathematically, from that point forward till the end of the year, you're going to see the equity component continue to grow as the company earns net income.
Right. So you indicated that that was a very successful offering.
Yes.
And very cost effective. And so I guess the other question I would have along those lines is we heard yesterday that the actual ROE at this time is 4.9 or 4.91%. And so I guess my question is, if the actual is at 4.91%, and you had such a successful offering, then how do you reconcile that with the concerns about Mr. Rothschild's
Yeah.
recommendations?
Really good question. So that's why we're here. That's why we're having a rate proceeding, is because it was a four handle on the actual return. So, we view the 9.94% ROE that could be awarded in this rate case as an opportunity. It's a potential for the utility to earn up to that amount. But there's regulatory lag in the investments that we have, and so it's almost the day after the rate case, you're already starting to decline in your actual ROE again. And so I would parse them slightly different, but I would say the issuance that I'm talking about was a bond offering. That's in the debt capital markets. We still have stable outlook and a very strong rating. Now, Moody's has put a few things, there's a few warning shots in here, when they say, on the front page of this report, credit challenges, the very first bullet is weakened financial metrics. That's where that realized 4-point-something% ROE is starting to show up. That just means that the cash flow, for the debt, I finance all of these capital investments on day one, and there's a lag in when we start recovering that cash. And so when that lag builds up, it starts weakening the financial credit metrics. That's what they're calling, and they're saying we're there, but they also know that we have a cadence and an ability to come in for rate cases and reach constructive outcomes. And so we're on stable outlook, and so when investors purchased that security, this is the information that they were basing that off of. So it's, it was a low ROE at the time, and when rates are implemented in, I believe it's August of this year, then that level steps up, the cash flow steps up, and that provides more stability to the utility.
All right, thank you. That's all I had at this time.
Sure.
Commissioner Carolee Williams.
Thank you, Chair Belzer. Thank you, gentlemen. As Commissioner Powers said, I'll just say it a little differently. We have a lot to learn, and from everybody in this room, and I look forward to kind of re-listening to some of what you said this morning as I internalize this and just try to learn as much as I can. I did the same when I was listening to customers, to consumers, and one of the questions that I've asked before in this case, but I want to hear your perspective on it, is many of the people we heard from are senior citizens who are on fixed income who only get an annual increase. And again, I think I know what I'm going to hear, but I want to hear it on the record. It would be ideal for them if we were looking at, a percentage increase each year that they could plan on and that they could budget for and know that they could afford each year. And it's hard to understand for them. You haven't come back with an increase in the base rate since 2018. How do you make those choices to stay out, to come in, and how do you mitigate that amongst the people who are going to have the hardest time paying for these increases? And I realize y'all aren't the perfect people for me to ask this of, but I have asked it before, and I want to hear it from your perspective. Does that make sense?
Well, it probably makes sense for me to start, Jim. Since I work for the company, I can tell you that, out of my group, I'm an input. I'm not the decision maker. But, what I provide to the regulatory teams and to Mike Callahan and his team is, when we start seeing weakened financial metrics, that's when I tell him, Mike, I need more cash. If I want to maintain this balance sheet, I need a little bit more cash. There's a lot of factors that go into the timing and filing of a rate case. And I really would take the timing of this case and maybe asterisk it just a little bit, right? Because we did have COVID and we are suffering from inflation, and my family feels it just like the fixed income, customers that you talk about. My mom is one of those. And so I understand, the need to try to balance. What I would say is we think as a company about how do we deploy capital and at what pace. It always goes back to customer rate impact. That's the very first lever that we always look at. So yes, there are demands investors would love for us to spend and provide them, but we know that we can only move as fast as our customers can take it. And so we think about that when there's capital allocation decisions, where can we deploy capital across all of these utilities that provide more safety, more reliability to the system, help transition the aging generation fleets to something newer. As we talked about, the bill and all of the data of people moving to the Southeast, there's all of the pressure from big customers that want to come here and they want us to make these investments. But at the end of the day, you have to pass all those costs through. And so I think that as we work through the next 10 years, I would imagine that even the dialogue that we have with you is going to change about how do we do that? And as a historical base rate case, and I'm probably getting over my skis here, but is a historical base rate case really the best way to do it? Or are there opportunities to think about multi-year rate plans where we come and we put an investment in front of you and say, how can we layer this in over time? From a cash flow perspective, I would say that's fantastic because it maintains the balance sheet and you don't have the lag on cash from the debt that you put on board. So I think that there's different tools and opportunities. I think you work under the constraints that you have today, but I think there's an opportunity as we work through this transition, to even work with the commission on better ways not only to recover quicker for the benefit of the utility and keeping it strong, but also for the customers so that they can plan and you don't have step change increases in customer rates. That would be my perspective.
I don't think I could say that much better, but maybe just a couple of additional perspectives from what I see elsewhere. I see rate affordability as a cross-cutting issue, probably the most important issue facing electric utilities in North America, maybe worldwide today. And I hear it in every jurisdiction that I testify in the U.S. and Canada. It's top of minds for commissioners, and especially so as we enter this period of energy transition where investments will be increasing for both gas and electric utilities and water utilities. And at a time when inflationary pressures are driving rates higher because the cost of all the goods that go into providing utility services are increasing. And I see utilities that are coming in for double-digit rate increases in a series of double-digit rate increases that are out for 1 or 2 years. And to me, one of my first reactions was when I read the settlement was that it is a 7.5% base rate increase because when you take into account the impact of the EDIT offset for a utility that's been out for 5 years. And we know that over those 5 years, we've seen extraordinary inflationary pressures. So that's one of the reasons why my reaction was that what's on the table in the settlement appears to be a pretty good value for consumers, especially given all that's occurred over the period of time that the company has been out. But it will be an ongoing issue, and rate affordability is something that I think every commission is dealing with across the country.
This may be out of your wheelhouse, but is there anything that you can comment on related to just the cost of the actual application process and hearing, and in terms of how it impacts when in general or when in specific a determination is made that it's worth it to come to a commission with a rate increase?
I don't think that I could comment on that.
Okay.
I would say that in the grand scheme of things, it's an important cost, but as big as those numbers can appear to be, nowhere near as large as the overall effort required to put together a rate case, and then the consequences of everything from raising capital to customer rates and everything else that needs to be considered. So I know it's a pretty major undertaking for a company such as DEC to put together a rate increase. I think it's everybody's, it's from an administrative efficiency standpoint, we see more and more companies staying out for multiple years, and I think that's a good thing as long as you have the kind of stability and reasonable parameters that allow a utility to stay out. So I think staying out for 5 years is a good thing, both from a commission perspective and from a utility perspective.
Yeah, I can certainly, and I can't speak to the cost component of it, but I can certainly speak to the efficiency. You know, we operate a very lean department. You know, for the amount of work that we do, you know, undertaking this amount of work is, it's a huge lift. And so, you know, I would agree and echo Jim's comments that, you know, it's more efficient, you know, to find a constructive outcome and have a plan for the future and to stay out of rates for a period of time. But, you know, sometimes it's just necessary.
Are there ways that the customer costs can be mitigated when you are staying out for such a long period of time? And I guess as you think about that, you know, I think about the past 5 years, but I also, you know, we have no idea of when you may be back with an increase. So,
yeah, I'll start with that. It's, I think there's a lot of efforts that go on, and sometimes they're very painful efforts when you work in a company this size, and a lot of that comes through O&M reductions. And there has been an incredible effort made across our company, even before COVID, to really watch the cost and really focus on it, because you could, you know, one could assume that inside the walls of a utility, it's very historical and you just do things because that's the way they've always been done. I can tell you at Duke Energy, that is not the way that we do things. We are constantly looking for efficiencies. We are constantly looking to automate processes, and we're taking costs out of the business everywhere that we can. And I think that's part of why this rate case has such a small increase to it. Most of the increase has to do with the capital expenditures that we made, not the underlying cost structure. And so we work every day to try to find and lean out the organization and be as efficient as we can. And I would say sometimes that's hard. It's more work on less people. But we, you know, in that type of environment, you adapt and you find what's important work to do, and that's the work that you focus on. But that's, I would say that is a strong focus of the company, is to manage O&M. And if you look at it over the past few years, it's actually been flat. And if you think about flat O&M in this inflationary environment, that is a huge undertaking.
this is a question. You all are the last Duke witnesses on the stand.
It all falls here.
So this question is one I wish I'd ask, and I know I'll be able to ask ORS about it. And I did try to ask something related to this, but Mr. Bauer, you really touched on it with the whole next 10 years growth that's happening in the Southeast. Have we done all that we can do to make sure that that growth is paying for itself? And I you know, as I think about that, I think about the allocation to the services class, which I know is not your realm, but if you can add any more to that perspective, I would appreciate it.
I can add a little bit. You know, when you think about when new folks move to our service territory, residential customers, you know, it just adds to the residential base, right? There's work that you have to do, and it's sometimes more expensive work because there's more lines that go to those individual homes. And so that's the work of building out the distribution system. Maybe you have to add a new generator because there's just more demand on the system. And so there's cost there. But when you start thinking about, you know, specific customers that are going to use a lot of load, that's important. And those are conversations that are absolutely ongoing. I think the company issued a press release yesterday. There was an announcement made that came out of Washington, D.C. with some meetings that we had that we're talking about these hyperload customers that are coming into our service territory that could take a lot of power. And so really what you'd read in that press release is it's just a memorandum of understanding between us and those customers that said we're going to work together. And let's make sure that there's not cross-subsidization, and let's make sure that the load that you're asking for is the load that you're actually going to take, and that we're not overbuilding our system, and then somewhere down the road you really don't take that much, and then customers are left with the overbuilt system. And so we are taking a very cautious approach as we think about economic development with some of these larger load customers, and we're making sure that there's proper risk mitigants in place, that the customer is taking risk and the utility is not bearing all of that risk and the remaining customers are not bearing. So I think that most of the economic development that we have in the state for us, fortunately, is not all just those hyperload customers. You know, that's, I think, about a quarter of our economic development is what we would call a hyperload customer, data centers, those types of things, and industries that support AI. We've got a lot of manufacturing, and that's good economic development for our state because there's tertiary investments that come off of that. So if BMW were to expand their operations, there's other, there's tire manufacturers and brakes and component parts, all of that bring jobs and tax base to the state. We see a lot of that. A lot of the onshoring of industrial customers back to the United States, we're benefiting from that. And so I think in all of that, there will be new generation that will need to be built. There will be new transmission and new distribution, but that will be shared and it will be thought about. But to get back to your question, the customers that look like they might take an outsized portion of maybe needing a new generator just to power their operations, we're not running to that. We're working with them very closely and strategically to make sure that there's proper risk sharing there.
I'm just thinking through all that you said to ensure. I mean, are you saying that the goal is, from your perspective and what you do in the company, is proper payment of services for the demand?
Yes, and I would say when we're making large investments, where I sit in the company is when we commit to a large investment, we think about the risk of that investment. Do we really need all of this? Do we need to build an entire generator to serve this? And if that's the case, then we think about the risk profile of that investment, and we just want to make sure that there's a proper blending and sharing of that risk. But for the most part in South Carolina, it's very broad economic development. It's residential growth, it's commercial growth, it's industrial growth of that. I'm speaking specific to a very large customer that might need its own generation resource.
Right. Thank you. I've learned over my skis and hyperload amongst other things today. So it does keep us going to hear those kind of those phrases. But thank you, gentlemen. No further questions.
Thank you, Commissioner. Commissioner Zane? Commissioner Caston?
Thank you, Madam Chair. And good morning, gentlemen. Can you hear me okay?
Yes, thank you.
Mr. Coyne, in your discussion with Commissioner Thomas, and I'll ask Ms. Perdue these questions too, but as I recall in her testimony, she chose not to use the CAP-M. So now, had she used the CAP-M, it would have provided a range, as you mentioned, I think like 8.39 to 9.97, which is higher than the settlement number. Had both of those been used by Ms. Pardue, that would have overlapped with Mr. Rothschild's ROE range. Is that an accurate statement?
Yes, I believe it is. She looked at her CAP-M results and dismissed them and I presume that she dismissed them because she felt as though they were too low and unrealistically low. And therefore, her range that I cited was based on her DCF results. And I commend her for doing that. Because there is a test of reasonableness. You know, if you look at it's easy to get lost in the technical aspects of what we do from a math standpoint and the analytical standpoint around ROE work. But if you take it all the way back to the Hope and Bluefield decisions that were written back in the 20s and 30s, I think 38 was probably the latest one, there's a lot of common sense in those Supreme Court decisions, and they really set the law of the land for this commission and other commissions for setting the cost of capital. And a basic tenet of those decisions is that it's the reasonableness of the result that you need to consider. And in my view, she considered the reasonableness of the results or lack thereof in dismissing her CAP-M results. And I don't believe that Mr. Rothschild's numbers pass the same test of reasonableness based on any other comparison to allowed returns and estimates coming out of other models with what I consider to be more reasonable inputs. So I think she applied a reasonableness test, and she did it appropriately.
Okay, I understand. That's your faults.
I'm sorry, Commissioner, I didn't hear your was it a follow-up question?
No, sir, not. I'm contemplating
Oh, okay.
follow-up
Okay.
question. Considering what you just said, and thinking about the comment and questions that Mr. Thomas had, and I also understand that models are models, and the inputs are judgment. Your judgment on your models, Ms. Pardue's on her models, Mr. Rothschild on his models. They're judgments, correct?
That's an interesting question. They're judgments in terms of the inputs you choose to use. And I think one of the things that distinguishes my work from the work of Mr. Rothschild's, and to a certain degree Ms. Pardue's, is that I try to limit the amount of judgment required by me manipulating data that's otherwise available to the market and available to investors. So if you look at the way that I approach the DCF model, for example, it's based on stock prices that are actual, yields that are actual and measured in the marketplace, and earnings forecasts from 3 different sources for utilities in the proxy group. None of those are my judgment. I've utilized judgment in selecting those sources, but I'm attempting to use market-based sources that I think would be available to other investors for populating that model. And the same is true with the capital asset pricing model. I'm using either actual or projected from a reputable firm, a risk-free rate, a beta that's measured in the marketplace and available through Bloomberg and Value Line to investors, and a market equity risk premium that's measured over 100 years of stock market history. So those are important data sources available to investors. If you contrast that with Mr. Rothschild, for example, he's taking a model or an approach to the CAPM using these option implied betas, for example, that's based on an academic article, not widely employed in the regulatory community, and coming up with his own estimates as a substitute for what's available from either Bloomberg or Value Line. He thinks that they're better estimates, but they're hard to follow. It requires multiple layers of spreadsheets based on his analysis, and you can't test it against any other source for its reasonableness other than to look at the reasonableness of the result. So I do think that's a distinguishing element for my approach, using market-based inputs or those from reliable sources rather than analysis that's based on something that's very individual to his approach and really can't be tested through the marketplace. So there are differences there. When Ms. Pardue relies on, in her approach to the DCF model, she comes to a more reasonable approach, and therefore her range is more reasonable, although it's not the same that I estimate. So there are big differences there that you get into when you get into the weeds of the analysis that are very important, that explain the differences in our results. And I would add that I think another important test is to look at the reasonableness compared to what other commissions decide. And I know that each commission likes to make up its mind independently based on the record evidence before it. But if you look at one of the exhibits that I have in the rebuttal testimony shows allowed returns versus the path of interest rates, for example, and it's my figure 7. And it shows, and this is pretty intuitive, it shows that as the path of interest rates have increased 30-year bond yields, and this is on page 50 of my rebuttal testimony, you can see that allowed returns are beginning to come up for electric utilities, and that's the kind of result you would expect. And so that's an intuitive test. You don't have to get into the bowels of these models to be able to examine these recommendations from a reasonableness standpoint.
I appreciate that, and that was a fairly long answer, but thank you. What I guess what I'm asking, or what I'm concerned about, I guess, is, you know, the parties obviously separate. You know, you prefer to do it the way you do it. Others prefer to do it the way they do it. But in questioning from last week, I think with you and Mr. Rothschild, both of you did not think it particularly wise or prudent to use just a model. And whether, you know, I will ask Ms. Pardue these things too, but it does seem all the assumptions that go into this, all the data that's got to be pulled from somewhere, that rather than using these two models that give me a range from 8.39 to 9.97, which is higher than what the settlement accepted, she settled on one that had a 0.21 range. Now, I'm not criticizing that. I'm not saying it's right or wrong. I guess what I'm trying to understand is clearly you believe the way you did it is more accurate and better than others. Obviously, Mr. Rothschild thinks his is more realistic or more accurate. I guess what I'm asking is it reasonable, or is a model that good, or your assumptions that good that you can discount a model, use one model, and have just a 0.21 range difference? Is that normal? Is that what you would normally expect to see?
I don't think so. I don't think that's a realistic portrayal of the data of the work that we do. You look at the range that I provided from my models of 9.78 to 11.3. That's typical. And that's one of the reasons why I like to use multiple models, in my case 4, because I know that each of those models is going to provide a range, and then when you add that range together, it becomes even broader. So it's unrealistic for me to tell you that you could narrow that range to 0.21%. So I solved that problem two ways. One is I look for consensus from the models, and therefore I'm taking the mean from all 4. I've also looked at the medians, and they come within a pretty tight range then. And then I also stand back and I ask myself, does it make sense? You know, if we can think about any of the courses we've ever taken in math or science, you always have to stand back and ask yourself, does the end result make sense? Is there some other measure I can use to verify what I'm seeing here? And the two measures that I think are intuitive are, one, what is the path of allowed ROEs for other utilities? Does it make sense for this utility today in the context of those other allowed ROEs? And as we talked about, the average for the U.S. on a trailing basis is 9.8%. We know that interest rates are going up, so that falls within this range, and that's actually at the lower end of the range that I estimate, which is 978 to 1130. And then secondly, look more broadly at what's going on in capital markets. Since this commission last set the ROE for DEC, the 30-year Treasury bond has increased by 150 basis points. So I asked myself, if 9.5% was correct in December 2019, and I know that the risk-free rate has gone up by 150 basis points, if a settlement would have the allowed ROE go up by 44 basis points, doesn't that seem reasonable to me? So I would take all those into context as I think about both the results from the models and the reasonableness of the proposed settlement.
Mr. Coyne, thank you so much. Mr. Bauer, hate to disappoint you, but I have no questions. So thank you, gentlemen. I have no more questions, Madam Chair.
You're welcome, Commissioner.
Thank you, Commissioner Caston. Commissioners? Redirect?
Yes, Chair Balser, just a few questions. And I might use the Elmo, in which case I'll switch over to the other side of the room. But to begin with, gentlemen, you were, Mr. Bauer, I guess, first, you were asked about a press release that the company issued with respect to the proposed settlement, both by Mr. Hall and I think Vice Chair Powers. Is some kind of communication to investors in the face of a potential material change in the company's financial status required under the securities laws of the United States?
Yes.
And do those laws exact very heavy penalties in the event the entity making the disclosure makes a misstatement of material fact in that disclosure?
Yes, that's governed by the Securities and Exchange Commission, the SEC.
Is that one of the bases when you said, even though I haven't read the press release, I can pretty much, not guarantee, but assume that whatever is stated in the press release is an accurate reflection of the facts available to the company at the time?
Yes.
Mr. Coyne, there was a lot of questions from Commissioner Caston and others relating to the varying ranges of the ROE results from you and Ms. Pardue and Mr. Rothschild. Do you recall those questions?
Yes.
Is it your recollection, Mr. Coyne, that Ms. Pardue's recommended ROE range overlaps to some extent with your recommended ROE range?
It does, yes.
And with respect to Commissioner Caston's questions that he and you were just engaged in a colloquy about, and he was concerned that Ms. Pardue appeared to rely on only one of her models, the DCF model. When you look at Ms. Pardue's results from her DCF model, and particularly in relationship to the proposed settled ROE of 9.94%, and you compare them to the results of your own models, as well as other data points, such as other authorized ROEs, does that give you more comfort with respect to Ms. Pardue's use, seemingly, of just one model?
It does. It's not my preferred approach. As I discussed, I believe, on Friday, even the FERC, which doggedly adhered to using one model, moved away from that. But the fact that I looked at how she approached her implementation of the DCF. I do take issue with some of her inputs pertaining to growth rates. I prefer analyst growth rates, and she moved away from that in one of her approaches. But I do think she approached it, at least from a more sound, fundamental financial standpoint than I did believe that Mr. Rothschild approached his analysis. So, and the fact that it overlaps with the results that I've estimated gives me greater confidence in the approach that she took.
And does to go back to Hope and Bluefield, does the overall result of 9.94 in the settlement square with your understanding of the end result test from those cases?
It does. As I indicated in my settlement testimony, it's within the range of reasonable results, and I think it does square with the Hope standard.
Mr. Coyne, just sticking with you for a moment again. Mr. Hall and many of the commissioners expressed a fair amount of angst related to the affordability of rates based on the settlement ROE and cap structure. And a note from your resume that you are certainly an eminent ROE expert, but also have considerable expertise in the electric utility industry, not limited just to ROE analyses, but also including rates and regulatory policy. Would you share your view with the Commission on whether parties to a comprehensive settlement or a utility commission implementing that settlement have available to them levers to impact rate affordability?
Sure. Yeah, I read the settlement with great interest, and one of the things that I took away from it was just how many levers there were in there pertaining to everything from low-income customers to energy efficiency to coal ash and cost of capital and resolution on a broad number of very complex issues. So it struck me as one that was balanced and comprehensive because of the numbers of issues that were resolved that are difficult for a commission to resolve when it has to act independently. So I thought it was commendable and consistent with what I see as good regulatory practice for the parties to come together on such a broad array of issues and to reach what they felt as though it's a reasonable compromise on behalf of both customers and the utility and other stakeholders involved that are considering issues such as environmental impacts, economic growth, and all the other complexities that go into these decisions. So I looked at it very favorably from that standpoint, from a policy standpoint particularly.
Would the accelerated flowback of the excess deferred income tax rider also, or accelerated flowback to customers of the excess deferred income tax also be one of those settlement sponsored levers?
Yeah, I thought that was very interesting and a very effective way to mitigate the rate impact because it brought, as I saw, it brought the average rate down from what would have been base rate from an 11.5% rate increase to 7.5%. So I saw that as being a very favorable lever.
Rate adjustment proceeding of Duke Energy Carolinas, which I refer to as DEC, or my direct testimony. I recommend the company provide annual
Mr. Morrow,
Somebody is.
you need to mute your. Sorry, Chair Belzer.
Somebody needs to mute. We're hearing. Is that one of your witnesses?
Yes, Chair Belzer.
Okay.
Apologies.
That's all right. It happens.
So just to conclude on that, I saw it as being a very effective use of that fund and a favorable one from a ratepayer impact standpoint.
How would you assess, Mr. Coyne, the effectiveness of those kinds of of affordability-related levers versus simply making a mathematical reduction in rates by lowering the company's authorized ROE?
Well, in the latter case, as Mr. Bauer explained well, it has a direct impact on companies. If there were a reduction in equity ratio or ROE without any other trade-off, then it obviously has a negative impact on the company's cash flows and prospectively on its credit quality. What I saw as being a creative use in the settlement of the EDIT balance is that, and my understanding of how that would work is that it would take a balance that the company already has on its balance sheet and just accelerate its drawdown to the benefit of customers, but I don't see that as having any kind of a negative credit impact on the company. So it's a creative use of an asset on the balance sheet that can be reduced for the benefit of customers without having a negative impact, and that's not the case of just a wholesale reduction in either ROE or capital structure.
Mr. Bauer, do you have anything to add to that?
No, I think that's well stated.
Mr. Bauer, Mr. Hall asked you questions concerning differing views that I guess it's S&P Global's research arm, RRA, has with respect to jurisdictions within the study area that they look at. Do you recall those questions?
Yes.
And do they actually prepare a report that's issued annually?
They do.
Chair Belzer, one of the documents that we looked at yesterday was the most recent report, the RRA jurisdictional analysis, and I would like to go ahead in light of the questions that Mr. Bauer fielded earlier to mark that report as the next hearing exhibit, and Ms. Green can hopefully dig it up and distribute it.
Madam Chair, I have a couple objections to it. First, I think it's a stretch to say that I asked about jurisdictional views. I realize that Mr. Bauer did mention RRA. Second, from what I recall of that report yesterday, I'd say it's hearsay. I don't think that.
Is this something that I did not allow in yesterday?
Yes.
I'm not going to allow it in today.
Okay.
Thank you.
Could we, Chair Belzer, mark it as an exhibit?
You want to proffer it?
Just for the purpose of proffer.
Okay.
And obviously it's not in evidence.
I can do that.
And if you still have your copy, we'll just use that one instead of distributing it. If not, we'll give you a copy.
I think you can give it to the court reporter. You don't need to give it to the commissioners. It's a proffer. It's not in evidence. And I think we sent them back, as I asked our counsel to make sure they went back. And this will be, I need it only for the purpose of putting it on my list, and then I'll give it to the court reporter. Getting the right title.
I believe we're up to 48, but
yes,
you correct me.
It'll be marked for identification as hearing exhibit 48 and proffered by the company.
And it's number, that's correct.
I just want to get the description correct, if she could hand it to me. Go ahead.
Thank you, Chair Bessel. Mr. Coyne, sticking with you for a moment. You were asked by one of the commissioners about the average 9.8 ROE that you referenced, I think, in your testimony as well as in your summary this morning. And just a couple of questions with respect to that average. First of all, is there a gradation among vertically integrated electric utilities with respect to risks to which they are exposed?
There are. When I do this work, I look at a lot of factors when it comes to measuring risk, everything from financial risk to business risk, and there certainly is a spectrum. And that's verified by the credit rating agencies and equity analysts that follow these companies.
For example, Mr. Coyne, would a utility that operates nuclear power plants be perceived as being exposed to greater risk than one that does not operate nuclear power plants?
Generally, that's the case, yes.
How about, Mr. Coyne, the perceived risk associated with, in this case, DEC's need to invest in additional resources in order to meet expected load growth due to South Carolina's economic development and population growth?
Capital investment risk is certainly a factor in terms of looking at both credit quality as well as equity investment, both opportunity and risk. And it becomes particularly important for a utility that doesn't have a forecast test year or something that accommodates capital on a forward-looking basis. So for a company that's experiencing growth with a historic test year, as is the case in South Carolina, it becomes a more important issue.
Thank you. And Mr. Bauer, just to turn to you briefly on the subject of authorized ROE.
Do we have much more? I think we need to take a break if we could.
We have more than just a few minutes.
Let's what time is it? I can't even see. It's 11:06. Let's come back at 11:20. Gentlemen, I'm going to ask that you not discuss your testimony with anyone or allow anybody to discuss your testimony in your presence. I'm not saying you can't talk about the weather, you can't talk about anything, just don't talk about your testimony or issues in this case. Thank you. 11:20, thank you. Good morning and welcome back to the Public Service Commission as we continue in our hearing in docket number 2023-388E and 2023-403E. Let's take a roll call of commissioners. With us virtually, we have Commissioner Caston, present in the hearing room. We have Vice Chair Powers, Commissioner Thomas, Commissioner Carolee Williams, and Chair Belser. And we are on redirect of the rebuttal panel of Mr. Coyne and Mr. Bauer. Mr. Meadow.
Thank you, Chair Belzer. And I took advantage of the break to look back through my notes. And I think whatever other questions I had are essentially repetition of what these witnesses have already said. So I have no further questions.
Thank you. Mr. Hall, anything limited?
No, thank you.
Thank you. Mr. Coyne, Mr. Bauer, thank you very much for being with us again today and for your perspectives, your testimony. We certainly appreciate your appearance here, and you may stand down. And then you're up to the whims of your attorneys.
At our peril, Chair? Yes, understood. And Chair,
With respect to Mr. Coyne, it's real peril because he's probably going to head up somewhere to the northeast and we'll never see him again.
Good luck, Mr. Coyne.
Well, come back and see us sometime.
Chair, as Mr. Coyne and Mr. Bauer walk off, just want to note that ends our rebuttal case. And so I believe it's back to you.
Thank you, Mr. Robinson.
Madam Chair,
Vice Chair Powers?
he might be headed back north, but he'll retire down here.
Depends on if he spends a summer here. That's I don't know where my list is. Let's see. I think we're the Officer Regulatory Staff. Is that right? Mr. Torrey?
Yes, Madam Chair. ORS calls Kevin J. Mara, please. And he is virtual.
He's virtual. Mr. Marr, are you with us?
I am. Thank you.
Good morning.
Morning.
Mr. Marr, I'm going to ask that you raise your right hand and let me swear you in, please. Do you solemnly affirm the testimony you're about to give will be the truth, the whole truth, and nothing but the truth?
I do.
Thank you. Mr. Torrey?
Good morning, Mr. Mara.
Good morning.
Could you please state your name for the record?
Kevin J. Mara.
By whom are you employed and in what capacity?
I am employed by GDS Associates. I am a executive vice president with the firm.
And did you prepare or cause to be prepared direct testimony consisting of 39 pages pre-filed in this proceeding on April 8th, 2024?
Yes, I did.
And did you cause to be filed a confidential version and a redacted version of your direct testimony?
I did.
Do you have any changes or corrections to your direct testimony?
Yes, on my direct testimony in table 4 on page 10, there's a value of 4.27 and it should be 4.5. That was the only correction.
And Madam Chair, we can file a corrected page if that helps the court reporter.
I think you were reading my mind. That
Yes, ma'am.
that would be very helpful, and if any other witnesses had corrections, it would be very helpful if parties filed those. You just have to file the corrected pages, not the entire testimony or exhibits. Would be very helpful. Thank you.
Thank you, ma'am. Mr. Morrow, would that change if I asked you the same questions today as those posed in your direct testimony? Would your answers be the same?
Yes, they would.
Madam Chair, I would move that both the redacted version and confidential version of Mr. Marr's direct testimony, as corrected from the stand, be entered into the record as if given orally, and that the confidential version remain under seal.
I've been saying Mara. Is that the correct pronunciation?
It's Mara like Tara.
Mara. Thank you. Mr. Mara's direct testimony will be admitted into the record as if given from the stand, and the confidential portions of his testimony will remain under seal.
Thank you, Madam Chair. I've only been working with Mr. Mara for 6 months, but I've been calling him the wrong name all this time. Mr. Mara, did you also prepare or cause to be prepared 2 exhibits marked as KJM1 through KJM2 that accompanied your direct testimony?
I did prepare those.
Do you have any changes or corrections to any of your exhibits?
No, I do not.
And those 2 exhibits were not confidential, correct?
That is correct.
Madam Chair, I'd move exhibits KJM1 through KJM2 into the record as the next composite hearing exhibit.
Mr. Mara's direct exhibits KJM1 and KJM2 will be a composite exhibit marked for identification as hearing exhibit 49 and admitted into the evidence of the case.
And Mr. Mayor, did you prepare cause to be prepared 10 pages of surrebuttal testimony pre-filed in this proceeding on April 29th, 2024?
Yes, I did.
And did you cause to be filed a confidential version and a redacted version of your surrebuttal testimony?
I did.
And do you have any changes or corrections to your surrebuttal testimony?
I do not.
Madam Chair, I'd move that both the redacted version and confidential version of Mr. Marr's surrebuttal testimony be entered into the record as if given orally from the stand, and that the confidential version remain under seal.
Mr. Mara's surrebuttal testimony will be entered into the record as if given from the stand. The confidential version will remain under seal.
Thank you. And Mr. Marr, your surrebuttal testimony did not include any exhibits, correct?
That is correct.
Mr. Mayor, did you prepare a summary of your testimony?
I did.
Would you please give it at this time?
Yes. Good morning, Madam Chair Belzer, Vice Chair Powers, and members of the Commission. I pre-filed direct and surrebuttal testimony in the current rate adjustment proceedings of Duke Energy Carolinas, which I refer to as DEC or the company. In my direct testimony, I recommended the company provide annual, measurable, and definitive metrics for grid performance to balance the performance with the level of investments. I also recommended the grid improvement plan be excluded from extended deferral counting treatment. And I recommended that the self-optimizing grid be deployed on feeders with existing capacity. My direct testimony is in response to the direct testimony of witness Fogg and Guyton. In my surrebuttal testimony, I have reaffirmed ORS's recommendation to not extend the deferral accounting treatment of the grid improvement plan, and this was in response to the rebuttal testimony of witness Fogg and Guyton. Subsequent to filing my direct and surrebuttal testimony, I understand the following parties reached an agreement resolving the issues, and that included the company, ORS, South Carolina Energy Users Committee, Southern Alliance for Clean Energy, Coastal Conservation League, Vote Solar, and the South Carolina Small Business Chamber of Commerce. I will refer to these collectively as the settling parties. I've reviewed the settlement with emphasis on the grid improvement plans deferral treatment, which the parties agreed to terminate effective August 1, 2024. I would note the ending of the deferral treatment is consistent with my recommendations. Therefore, the terms of the settlement agreement are reasonable to me, and ORS would request that the Commission accept the settlement in its entirety.
Thank you, Mr. Mayor. Madam Chair, Mr. Mayor is available for questioning.
Thank you, Mr. Torrey. Department of Consumer Affairs?
See, I think we're still good morning, Mr. Mayor. How are you?
Good, thank you, sir.
Can you hear me okay?
I can.
Okay, great. So is it correct that you've been an engineer working in electrical distribution for over 40 years?
Yes, that's correct.
So would it be correct to say you have extensive experience in transmission and distribution infrastructure, upgrades and replacements?
I do indeed.
And you've developed engineering training courses on the general subject of distribution power line design. Is that correct?
I have.
So therefore, I think, would you agree that you are a highly qualified expert in this field?
I would like to think so, yes.
You testified, I think it covered in your summary, but you testified primarily about the grid improvement plan. Is that correct?
That's correct. That was my focus.
Okay. And I think these numbers have been covered before, but just to confirm, the company invested $371 million in distribution and $177 million in transmission. Does that sound right?
Yes, related to the grid improvement plan, yes.
Yes, thank you, under the grid improvement plan. Based on your experience with an investment of this size, would it be correct to assume that reliability should improve?
That was my expectation, yes.
And is it correct that DEC's reliability worsened despite the large investment?
Could you repeat the question?
Is it correct that DEC's reliability worsened despite the large investments?
Yes, that was, I had that included in my testimony. It did worsen.
And did it also worsen excluding major event days?
Yes.
Did the utilities testimony mainly blame vehicle accidents and hotline tag outages for the decrease in reliability?
Could you repeat it again? I'm having some difficulty with my sound. My speakers are.
Yeah, I can always probably be clearer and louder. Too. Is it correct that the DEC mainly blamed vehicle accidents and hotline tag outages for the decrease in reliability?
They pointed to both of those categories as a reason for the increase. Yes.
And would it be correct to say that reliability worsened even excluding hotline tag outages and vehicle accidents?
I believe that's correct, yes.
Okay. Do you recall any other reason that DEC provided for the worsening of the reliability outside of any other issues that it's addressing, such as vegetation management or animal fencing? Any other reasons you recall for worsened reliability?
I believe they pointed to storms that didn't classify as major events. So they had really strong storms that didn't go to major events, but had an impact on their reliability. I remember that was something that they pointed to.
Thank you. Is it correct that looking regionally throughout the Southeast, that DEC's South Carolina grid is the least reliable?
I'm not sure I would classify it as the least reliable. I did, in my testimony, do a comparison of a select number of utilities in the Southeast. And DEC's system was, I would put it at least the bottom quartile, the bottom of the group, but maybe not the absolute bottom every year.
Okay, fair enough. I just want to show that, make sure we're talking about the same thing. I'm going to put on page 7 of your direct testimony. And I'm not sure if I can see it all. We don't necessarily need to see the whole thing here. I just want to make sure that, is that what you were referencing from your testimony on the analysis you did?
Yes, yes, it is. That page 7 for my testimony.
Okay, and if not mistaken, you said you would at least put them in the bottom quartile in the Southeast in reliability?
Yeah, they weren't the bottom every year, but in general, they were in the bottom quartile.
Thank you. And have you heard and seen Mr. Guyton talk about that resiliency needs to be considered as well?
Yes, I did hear his testimony regarding resiliency.
Are you familiar with at all with Duke's 2018 case?
No, I'm not.
And in your testimony, you kind of look specifically at residential benefits for some of the GIP programs, right?
I did specifically in my rebuttal testimony, I believe.
And would it be correct to say that the residential benefits from the majority of the programs are smaller compared to that of commercial and industrial customers?
The methodology that DEC used was the Department of Energy's ICE calculator. That's the interruption cost estimator. And using that cost estimator, it showed more of the dollar benefits going to commercial industrial and less going to residential customers.
Would it be correct to say that the benefits used in the CBAs, the cost benefit analysis, they're not based in monetary savings? Is that right?
That is correct. On the residential side, the way the ICE calculator works is a question was posed to consumers: what would you be willing to pay to avoid an outage? And so the value of an outage saved would be what would they be willing to pay. So there is no direct benefit to those residential customers. To some of the commercial customers, the survey data did try to take into account lost business revenues.
Would it be correct to say that the ICE data that you mentioned is highly subjective?
It is highly subjective. The standard values that are in it are based on an average or a blending of 8 different surveys from around the country. And it's those values that are often used by utilities. But the DOE website for the ICE calculator also includes a methodology for utilities to develop their own costs, to estimate what the cost would be locally for their utility. And so that methodology is available, and I understand that DEC did not use that particular methodology.
Thank you. So with the methodology they use, would it be fair to say that under their cost benefit analysis, Duke overestimated the benefits?
Could you repeat it one more time, your question one more time, sir?
Yeah, given the methodology that they used, would it be fair to say that Duke overestimated the benefits?
At least they did cost benefit analysis for a number of different programs. The one I looked at specifically in my survey rebuttal was on the self-optimizing grid, or the SOG. I believe they used the program correctly, and they got numbers out of the program. Those numbers do create a very high value of benefits for commercial customers.
You talk about in your testimony, looking at page 13, lines 5 to 12, you talk about the cost benefit analysis related to replacing older devices. I'll give you a second to get there.
I'm on page 13. Which line, sir?
5 to 12.
Okay.
If my notes are right.
I'm there.
Rather than having you read that, could you just explain to me what you're, and to the commission, what you're saying about the cost benefit analysis and the replacement of older devices?
So as an example, if you have a power transformer that's old, um, if you do a cost benefit analysis of replacing it, the assumption is, and one option is you don't replace it and it fails and there's an outage. And the other option is you replace it and there's no outage. Well, the utility has a responsibility to replace the transformer. So you can't make that type, in my opinion, you can't make that kind of benefit analysis when the device has to be replaced anyway, if it's at the end of its useful life. And that's what I was referring to. And there was a number of different improvements that fell into that category of it's aged, it has to be replaced anyway. So the cost benefit to me didn't make sense the way they were applying it.
Does that issue that you identified, does that skew the benefits or the costs or both?
I think it doesn't make a fair comparison between the do nothing option versus the option to do something. It essentially assumes that you're going to reduce outages because you replaced the component. Well, you had to replace the component anyway, so the change in outages would be zero. That's what my criticism of their methodology was.
Okay. Thank you for that clarification. Would it be fair to say for the programs you evaluated that Duke had a tendency to underestimate costs?
I don't believe I looked at it from that perspective, so I don't know that I have an opinion.
You looked at the targeted undergrounding program, is that right?
I did.
Okay. And what was your assessment of the targeted undergrounding program?
Could you repeat the question? I'm sorry.
Yep, sorry. What was your assessment of the targeted undergrounding program?
The targeted undergrounding program is becoming more popular, if you will, within the industry. So it's not surprising to see it become an option for DEC to use. I mean, my criticism was that targeted undergrounding needs to be used sparingly because it's such a high expense to convert from overhead to underground.
Would you agree that the majority, and I think you alluded to this, but would you agree that the majority of the grid improvement plan is merely replacing equipment that's near the end of its life cycle?
Yes, I would agree with that.
Would it be correct to call replacements like this extraordinary or unusual?
No, when it's ordinary replacement of aged facilities, the utility should have the ability to forecast and see when those replacements need to be done and manage those replacements accordingly.
So would it be correct to call such replacements routine?
Yes, in my opinion.
And I think throughout your testimony, you discuss how these programs are routine activities that all utilities have to do, right?
That is correct.
And so would you agree that these grid improvement plan expenditures, I think as you've stated in your testimony, do not warrant deferral treatment?
That was in my testimony. Yes, sir.
So you mentioned the SOG program earlier, and that's the self-optimizing grid, right?
That is correct.
And would it be correct to say that the SOG did not deliver meaningful system improvements?
Could you repeat the question?
Would it be correct to say that the SOG did not deliver meaningful system improvements?
The self-optimizing grid was applied to 9% of the feeders. Duke presented documents that showed it reduced SAFE and SADI for customers on those feeders, but the reductions were, in my opinion, relatively small compared to the investment that they had made to achieve those reductions.
And looking at, let me just make sure I've got a rebuttal or surrebuttal. I believe it's your surrebuttal, page 11, lines 5 to 7.
So rebuttal page
11, lines 5 to 7.
Okay.
And I think that captures what you were just saying, but there, again, if I have my line numbers right, you say, therefore, my conclusion remains that the SOG program provided only slight benefits in terms of improved SADI without meds or major event days of 3.55 minutes in 2022 and 4.5 minutes in 2023. Is that right?
That is correct.
Okay. Can you explain what that, we're talking about minutes there. Can you tell me what that we're talking about? Is that total minutes? What is the
Sure.
frame of reference for minutes?
Yeah, so SADI is the System Average Interruption Duration Index. So it's a measure for a system is how long does a customer not have power in a year. And so for Duke's system, the SADI numbers were 148 minutes in 2022 and 188 minutes in 2023. So 188 minutes is about 3 hours. So the average customer was without power for 3 hours. The reduction that they achieved with the SOG system-wide then was just a reduction of 3.5, 4.5 minutes.
Thank you. And do you recall, I believe it's back on page 10 of your surrebuttal, what the costs associated with the SOG program were?
You'd have to point me to the page. I don't remember.
I believe it's the prior page, your surrebuttal, page 10, lines 7 to 9.
Yes, thank you for pointing me to that. It was 58 million was spent between 20 and 23.
Okay. And so $158 million to reduce outages by 3.5 minutes, 4.5 minutes. Is that right?
That's correct.
In your opinion, is that a cost-effective way to increase reliability?
The 60% of the money that Duke was investing had to do with increasing capacity to use the SOG for a wide range of loading. Essentially, when you have an outage on one feeder, you could switch all the load to an adjacent feeder, but only if the adjacent feeder had enough capacity. Duke had to invest in increasing capacity on the adjacent feeder as well as at substations and increase transformer size. And so because they had to make those investments, it, to me, makes the SOG not a very cost-effective. The SOG programs are pretty intelligent these days. And what it could do is it could say, hey, the feeder went out. I've got 3 megawatts of load to shift to the adjacent feeder. How much capacity is left on the adjacent feeder? There's only 2. And decisions could be made to switch or not switch. You wouldn't necessarily have to increase capacity on all feeders and instead use the logic of the SOG. Prove that the SOG is working and then add capacity where it makes sense over a longer period of time.
Thank you. I'm going to ask, you had some testimony about the Integrated Volt VAR Control Program, or IVVC, is that right?
I did.
And what were your recommendations regarding the IVVC?
The DEC provided a cost-benefit analysis for the IBC, and I reviewed that and thought that it didn't include the projected costs that were going to be included for the future years. And when I included those projected costs, I saw the cost-benefit analysis fall below 1. And so my recommendation was that DEC should update their cost-benefit analysis to be sure that the costs of the program were still less than the benefits the program was generating.
Would it be fair to say that that cost benefit issue was because the spending outpaced the original budget in the CBA? Or the original cost estimates?
I'm not sure I could make that conclusion. I know that the cost benefit analysis that I looked at had a lower capital investment than what I saw looking from 2020 out to the future years of 26. Duke's rebuttal was, yes, we didn't capture all those costs, but you don't have the most current CBA, which shows more benefits. I think my recommendation still holds that I believe they should update their cost-benefit analysis for that program.
And are they going to be updating that under the settlement agreement?
I don't believe that's included in the settlement agreement.
Thank you. I think I asked you earlier, so this might be repetitive, but it's correct that you said that undergrounding is generally not cost effective?
I believe I had that in my testimony. I'm not sure we covered it earlier, but yes, that is my testimony.
Okay, and I'm looking at your direct page 30, starting at line 16, going into page 31.
Yes, that's my testimony, is that undergrounding is generally not cost effective.
And I believe you mentioned some more cost-effective alternatives, and Mr. Guyton spoke to some of this yesterday, but you testified, you testified similar to DCA witness Borden about more cost-effective alternatives, correct?
There could be more cost-effective alternatives for specific locations, yes, sir.
Okay. And that'd be true with existing tree cover?
Yes.
Okay. Did the cost-benefit analysis for undergrounding rely on commercial and industrial customers as opposed to residential?
I don't know if I can answer that question.
Okay, and I don't want to misinterpret your testimony. I'm looking at that same page 31, lines 6 to 16.
Yes, I see that.
And could you either read that or summarize it for me, please?
Mr. Hall.
Sure.
Excuse me, Mr. Mara, just a second. I believe there's what's been marked as confidential information in that.
Let me double check.
I just want to make sure.
Yes, I will stay away from the confidential information.
Thank you, Mr. Mara.
So in the cost-benefit analysis for targeted undergrounding, the assumption is that if we left it overhead, let's just say in the backyards with tree cover, that the lights would blink, and upstream there would be commercial customers that would see those blinks, and they would have costs associated with those blinks. When you underground at that point, then those blinks go away, and the upstream customers no longer have those costs. So those costs to the upstream customers really turn into benefits in the cost-benefit analysis. And so that's what I was referring to there, is that blinks to the system, reducing the blinks to the system generated benefits to upstream commercial customers in the methodology used by DEC.
Would it be correct that if the CBA relied solely on residential customers, the cost benefit analysis would have came out under 1, meaning the cost exceeded the benefits?
I didn't run that particular scenario, but it wouldn't surprise me if that was the case. There was a lot of benefits associated with the commercial customers.
So you would agree, I think, overall that some of the company's cost benefit analysis are questionable, correct?
Yes, I had a lot of questions regarding the cost benefit analysis in my testimony.
And at least as to residential customers, sounds like from your testimony that many of the benefits from the grid improvement plan are minimal. Would you agree?
Using the ICE calculator, the accrued benefits to residential customers are much lower than commercial industrial.
Okay. And we already discussed the grid improvement plan has not improved reliability, correct?
Say that one more time, sir.
The grid improvement plan has not improved reliability, correct?
That's correct. To date, we haven't seen a reduction in safety numbers after their investments from 20 through 23.
Given everything you found in your testimony, do you think the grid improvement plan is a prudent investment?
I didn't have any of the programs that I specifically identified should be excluded from future investments. My focus was on excluding it from deferral treatment. Aged infrastructure still has to be replaced. And that's really what a lot of the grid improvement plan is about. So therefore, I didn't identify anything as being imprudent investments.
I understand. I appreciate your time. That's all the questions I have.
Thank you, Mr. Hall. Commissioners? Commissioner Carolee Williams?
Thank you, Chair Belzer. Good high noon, Mr. Mara.
Thank you.
I want to talk just a little bit about page 7 of your direct testimony. And that's the one where you identified 8 or 9 or so other utilities in the Southeast that with regard to SAIDI and SAFE.
Yes, ma'am, I'm there in my testimony.
And I guess what I wanted you to talk me through was what happened over time. And so I'm looking at the flow of all of those utilities, but I'm particularly looking at the bottom line, which is Duke Energy Carolinas over time. Would you, and I would just want to understand what the numbers mean from your perspective for Duke Energy Carolina for 2018 to 2022.
So
go ahead.
On page 7, the bottom of the page is the SAFE number, which is the frequency of outages, right? How many times did the lights go out on a per customer basis? In 2018, it was 1.28. And then it dropped down. We saw improvements from 2019 through 2021, but then it bounced back up in 23. Being down at a value of 1 is kind of middle of the road for utilities. So, we saw a period of time where it was reasonably good, but it's bounced back up. In terms of SAIDI, SAIDI is often thought of as a consumer indice, and that I know that I didn't have power at my house for 2 or 3 hours for a year. It's not the frequency of the outages, it's the duration. How long was I out? And those numbers are not very consistent. In the range of 2.5 to 3 hours is relatively high in comparison to other utilities. Part of that is response time, but through the course of this case, and as I talked about the SOG and how Duke had to invest more money in order to make the SOG work, because they had to add capacity. Normally with outages, when there's an outage, if you can switch load to another feeder or another substation and get power back on, you reduce SAIDI quite a bit. Without that capacity, you can't do that. And so I don't know for a fact, but my thought is that might be an underlying reason for these higher numbers for DEC compared to some of the other utilities in the group.
And did you pick the other utilities because they are, why did you pick the other utilities? Things that come to my mind are comparable weather, comparable.
I picked those utilities as being in the Southeast. I didn't think Florida was a good example just because of their weather patterns and hurricanes that they see is just different. So I focused on along the East Coast, looking at investor-owned utilities. I did select 2 larger utilities in Chattanooga and Nashville. There's no real large investor-owned utilities in the TVA area, and those 2 were representative. And so that's why I selected those 2.
And do you know if those utilities are also experiencing challenges with vehicle incidents or with, and I might get this wrong, hot tag issues?
Hotline tags.
Hotline tags. Okay.
Mr. Marr, I'm going to ask you to pause just a second. We've lost you a little bit on the screen, and court reporter needs to see you. There we go. Thank you.
There we are.
Thank you. I'm sorry to interrupt. Please go ahead.
I don't know if they've had issues in the other jurisdictions with vehicle incidents. I know that hotline tags is a issue throughout the industry. Essentially, when a worker is going to work on a line energized, we don't blink the lines. We automatically turn it off to protect the worker, and that's a hotline tag. There's a lot of times when someone is at a work site and a squirrel gets on a line a mile away, and then the feeder goes out, and that's where you have that hotline. We call them hotline outages, and that's something the industry is struggling with to try to improve that without jeopardizing worker safety.
And with regard to grid enhancement technology, do you assess that to be something that should be standard, or is that something that's above and beyond?
The SOG program that Duke is rolling out is being rolled out by many different utilities around the country. I think it is the wave of the future. Technology has moved to a point where we can do this more effectively. The concept was really brought up in the 80s and 90s, but today it's just more with communication and computer speeds. We can do these self-healing systems now. So even in my testimony, while I was not in favor of the deferral treatment for all the programs, I did identify that the advanced distribution management system and his segmentation, which are really the heart of the SOG, could be included if the commission wanted to go in that direction.
Thank you very much. No further questions.
Commissioners? Questions? Redirect.
Briefly, Madam Chair. Mr. Mayor, and Mr. Hall asked you whether you believed the grid improvement program was comprised of routine maintenance activities, routine maintenance and replacement activities, and thus did not warrant deferral treatment. Do you recall that?
Yes, I do.
And in your testimony, based on that conclusion that you reached, you recommended that the grid improvement plan deferral be terminated. Is that correct?
I did, yes, sir.
And in your summary, you noted that the settlement agreement provides that the grid improvement deferral will in fact terminate as of August 1, 2024. Is that right?
Yes, sir.
As such, do you believe the settlement agreement is in the public interest?
Yes, I do.
And finally, in response to questions from Mr. Hall, in discussing your testimony, you indicated several times that you believed that your recommendations that you made in your testimony were still valid and you stood by those. Do you remember that?
Yes, I do.
In light of the settlement agreement, in light of the nature of the settlement agreement, do you nonetheless support the settlement agreement?
Yes, I do.
Thank you, Mr. Mayor.
Thank you, Mr. Torrey. Mr. Mara, thank you for your appearance today and for your testimony. We certainly appreciate your perspective and the information you've shared with us, and you may stand down. Thank you, sir.
Thank you. Thank you, madam.
Okay, parties, I want to ask, okay, we're at 12:10. If we need to take a lunch break, can we take a short one? I don't want anybody to be uncomfortable. Would you like to break for 30 minutes or so now? And then we can come back and go for till about 2:30 or quarter to, is that okay? Or do you want to keep plugging through till about 1? But then that's going to make the after break session a little short. Break?
Yeah, I think if we're taking a break at all now would probably be a good time.
Okay, is 30 minutes okay? Can everybody get a power bar or a soda or apple or something? Okay, so let's break for about 30 minutes. I'm showing 12:08 on my phone, so let's come back at 12:40. 12:40. And then, who's next, Mr. Torrey or Mr. Austin?
That'll be the next panel of Mr. Lawyer and Ms. Pardue.
Okay, thank you very much. 12:40, thank you, we're in recess.